Yes, good afternoon, everyone. Please check, am I audible and is the video clear? Okay, thank you for the confirmation. Just one more minute and then we'll start. Yeah, all clear from my side. Okay, so let's start. So today we are going to cover with one of the big Ind AS, one of the very important Ind AS, because this can be directly asked for 14 plus 5 marks also. That means you can say there's a weightage of 20 marks approximately of this chapter. And if you will completely understand this Ind AS, then the next Ind AS, which is 110, that is nothing but consolidated financial statements, that will be very easy for you. Only if you cover 103. If you don't cover 103, 110 obviously is not possible for you. Okay. So now let's start with 103. See, what I'll be doing today is I'll be recalling each and every concept. I'll be taking the revision of each and every concept. So initially I'll be taking a concept, then a question, concept, question, and together I'll be covering all the concepts, right? And later on we'll check whether there are any questions left for it and we'll be solving those also. That means I'll be covering the complete Ind AS 103. Obviously it is a huge Ind AS, so it will take a bit of time, but please be patient and just listen to me very calmly. Okay, just try to calculate wherever possible. Obviously I will not be able to give you a lot of time to copy and something, and that's why I've made the board notes. I'll be providing you with the board notes also, which will be very useful for your revision. Okay, so in this I have taken all the concepts and all the questions also. There are I've taken a variety of questions, and I'll give you my procedure. How do I proceed with the question, right? So let's not waste any time and let's proceed with Ind AS 103, that is business combination. Now, if you can check the number line on 1421, control was established. What is exactly business combination? If I take over a company, what do I mean by exactly taking over a company? I can take over by purchasing 51 or more % of shares of the equity, right? So if I'm purchasing more than 51%, obviously I will establish a control on that company. And once the control has been established, I can make the consolidated financial statement using Ind AS 103 and find the value of goodwill or the capital reserve, or else we can say gain on bargain purchase. It is nothing but capital reserve only, which is nothing but gain on bargain purchase, right? Which we say GBP. Now, why 103 and why not 110? See, for the first time when the control is established, you have to make consolidated financial statements on the date of acquisition itself, and that time we follow 103. And again, obviously, for every year you have to make consolidated statements every year, but that time you will be following 110. That means for the very first time you just have to follow 103, and in the subsequent years you have to follow 110, right? That means goodwill will not be calculated on, goodwill will only be calculated on the date of acquisition and not in future years. That means you have to calculate goodwill only on DOA, that is the date of acquisition. Okay, so first thing is clear, when to apply 103, only on the date of acquisition, not in the subsequent years, because we are applying 103 to find the value of goodwill or capital reserve. That is nothing but GBP over here. Okay, fine, moving ahead. Now I have given you a concept question over here. Just pay attention on how I will proceed with the question, right? So this is a concept question, how to make the CFS. Read, I have purchased something, that is I already have my balance sheet, plus I'm purchasing something. That means, can I say I'm purchasing someone's assets, someone's liabilities? So I'll take it over all the assets, all the liabilities, but I will not take over at the book value. I will take over all the assets, all the liabilities at the fair value. Fair value is nothing but the market value which will be given. Now, if the fair value is not given, I will be telling that I will take at book value itself. Now, over here you can see A Limited purchased 80% shares of B Limited for cash consideration of 380. That means I paid them cash of 380 and I took over B Limited. But I haven't taken B Limited entirely. I have taken only 80%. So whatever the capital is, I have taken 80% of this. That means what I'll be doing is I'll take away all the assets and I'll take up all the liabilities. I'll say your assets are now my assets because 80% is my holding. Your liabilities are now my liabilities because 80% I am holding, right? But for that 20%, I'm not holding that. And that 20% is known as NCI, that is non-controlling interest. 80% I can control, but that 20% I cannot control, right? That 20% is known as NCI, that is non-controlling interest. Point to be noted over here is I cannot take your share capital and equity. So basically what I have to do is I'll copy paste my balance sheet as it is. A Limited will copy paste the balance sheet as it is. I will pick all your assets, all the liabilities. But the problem over here is I haven't taken you 100%. Why I'm taking all the assets then? I should take only 80%. But the rule says you have to take 100% of the balance sheet of the acquiree, right? So I'll take 100% of it, but 20% is not mine. So in that 20%, I have to write NCI in the balance sheet. That is 20% I have to pay it to someone, right? Now, when I calculate this blue box and the green box, the difference, it is known as INA. What is INA? Identifiable net assets. Net assets is nothing but assets minus liabilities, but assets minus liabilities at fair value, not book value, right? So what I have to do is I just have to add and add. That means if you can closely watch this balance sheet, what do I have over here? I have PPE of 8 lakh. So 8 lakh will be there obviously. Plus I'll be also taking the B Limited's PPE, but I will be taking PPE not at 2 lakh but at 2,80,000. But at 2,80,000. So this is the fair value which is provided to them, right? Intangible assets are there. The value is given as 70. Inventories, there is no information given. So I'll be taking a 50 only. Because if the fair value is not given, the book value itself becomes the fair value. Okay. Receivables, the 140 is given, 140. Bank, nothing is given, I'll take it 40 itself. Next, debentures, 90,000 is given, as I'll take 90. Payables, 50, no information is given, I'll pay it 50 only. That means I'll be taking the fair values. So what I have to do is, I'll copy paste my balance sheet, plus I'll take over all your assets, all your liabilities, but at fair value. At fair value. If fair value is missing, then book value. Now, who is the acquirer over here? Who is taking over? A. He becomes the acquirer. B is selling off this business, right? So B becomes the acquiree. Okay, these are some of the terms. Now, you can see at this diagram what I'm taking over. If you can check the blue box, I'm taking all your assets. Not even a single asset is kept with that. I'll be taking all the assets. I'll be taking all the liabilities. If you can closely check the purple box, this one, share capital and other equity, this won't be taken. Only this will be left out with B. Rest every item of the balance sheet I'll be taking, but at fair value. So what I have to do is, how will I make consolidated financial statements? I'll just add up my balance plus whatever I'm taking up. I'll just plus and do the rest. But two things will be remaining. First is NCI over here, and the next is goodwill. I just have to record these two things over here, right? Okay, moving ahead. Now, how will I record? So, fair value of identifiable net assets. How will I calculate the fair value of identifiable net assets? That in short, I will be telling INA each and every time. INA, that is identifiable net assets. How will I calculate? I'll take over all the fair values of the assets minus liabilities. That is assets minus liabilities. At which value? At fair value. This is known as net assets, INA. So over here, the net assets come to 4,40,000. Over here, the net assets comes to 4,40,000. Now, to value NCI, I have two methods, always two methods. Just give me 1 minute. Yeah. To value NCI, I always have two methods. What are the two methods? Now, if the method is not given, you can assume anything. And always first method is preferred. Now, how to measure NCI? There are two methods to it. See, I can say I have purchased 80%, and I have paid 3,80,000. That was given on the first line. I have purchased 3,80% and I have given the consideration of 3,80,000, right? That means, can I say I have taken entire balance sheet at 440, but I cannot say this 440 is completely mine. I can say 80% is mine because I have taken you, 80% is mine, but 20% is not mine. So 20% will belong to NCI. Now this is known as PSNA. Now what is PSNA? Proportionate share in net assets. When I say NCI, that is non-controlling interest, is measured at PSNA, that means whatever the net assets are, I will give percentage to NCI. 80% is mine, 20% is yours. That means 20% will belong to NCI, that is non-controlling interest. 80% belongs to me. Now this is the first measurement, case 1. NCI is measured at proportionate share of net assets, that is PSNA, right? How to measure? 4,40,000 was INA, 80% is mine, 20% is yours. 80% I'll take, that is 3,52,000 belongs to me and 88,000 belongs to NCI. That means, see over here, if these are the two balance sheets, I'm taking 100% of your assets, I'm taking 100% of your liabilities, 100%. But truly speaking, 100% is not mine, 20% is someone else, right? So because I have taken 100%, I have to show NCI over here. That is my liability. How come it is liability? Obviously, 80% was mine, but I'm taking 100% of your balance sheet. How can I take that? And therefore, I have to take 20% to NCI, because that becomes my liability. I have to give this 20% to non-controlling interest. This is the point, right? Okay. This is the first method. Now, how to calculate goodwill? See, it's very simple. How will I calculate the journal entry? Whenever you purchase an asset, what is the entry you will pass? You will say, sir, asset account debit to bank. Is this the normal entry? The answer is yes. When I say you purchase an asset, think from the point of view of A, that is acquirer. You are acquiring something. If you purchase an asset, what is the journal entry you will make? Obviously, you will say asset to bank. Over here, I am telling you, don't write asset, write INA, that is identifiable net assets. I have already calculated assets minus liabilities taken over at fair value, INA to bank, right? But over here, can I say there is also one more liability which I am taking over, that is NCI. That is NCI, right? So in this scenario, what is the journal entry which I'll make? Can I say I have paid 3,80,000 to bank? That is to bank will be 380, and INA I have taken 4,40,000. Also, the NCI's share was 88,000. I just now calculated it, 88,000, right? Because it was proportionate share in net assets. How did I calculate this? It is very simple. This is 4,40,000. I will give 20% to NCI. That is 100% was not my share, and therefore I gave 20% of whatever the identifiable net assets were. And the difference will be either goodwill or GBP. GBP is nothing but gain on bargain purchase. Similar concept of capital reserve. It will be treated as a capital reserve itself, but you have to write gain on bargain purchase. That is GBP. You can write GBP also, right? So wherever the difference is, if the difference is in debit, obviously goodwill. If the difference is in credit, it will be GBP. So it becomes a normal entry. This is how you pass a journal entry. Don't learn the journal entries. Think of the proper adjustment. What you are doing, basically you are purchasing an asset, and therefore it is known as asset to bank. But that is not only one asset, right? There are a lot of assets and liabilities also. So I make INA to bank. Obviously 100% is not mine. So whatever the other portion is there, I have to write to NCI, and the difference will be treated as goodwill. Over here, you can say the goodwill is coming out to be 28,000. Now, since I have taken 80% only, that goodwill is only 80%. That means I can say it is only partial goodwill. It is not 100% goodwill. It is only partial goodwill. Now, what is the meaning of partial and full goodwill? It will be, you'll be getting this concept in Ind AS 110, which I'll be taking next. Okay. So I'll be explaining this concept again once again over there also. So basically, whenever I say NCI is measured at PSNA, that is proportionate share in net assets, the goodwill which we get, we call it as partial goodwill. It is only our goodwill, not the NCI goodwill, right? Okay. But the second method which I can follow, NCI, is nothing but NCI is measured at fair value. That means I am having two methods. NCI is measured at PSNA, and NCI is also measured at fair value, right? Now, how will I measure at fair value? It's very simple. For 80%, how much did I pay? 3,80,000. So what is the value of this, the balance 20%? That is basic cross multiplication. See, first method was 4,40,000 was INA. INA is identifiable net assets. What I will say is 80% is mine and 20% is NCI. 20% is NCI. So this 20% will belong to NCI, and goodwill, which will be called as proportionate goodwill, that is partial goodwill, because that goodwill only belongs to me because I have given 20% to NCI. But second method is NCI will be measured at fair value. Now, what is fair value? How to calculate that fair value? See, you have paid 80%. You have paid 3,80,000 for how much percent? 80%. 3,80,000 for 80%. So what is the value for the remaining 20%? Just cross multiply and get the value. So this will come to 95,000. Now what you have to do is again the same entry. What was the journal entry? It is INA to bank. Always think the normal purchase entry of asset to bank, that is INA to bank, right? Okay. Can I say something belongs to NCI, that is a liability for me, right? So this time it will be 3,80,000 and NCI will be 95,000. This time the INA was 440. So whatever the goodwill will now be, it will be termed as full goodwill. It will be termed as full goodwill because I have measured the NCI at fair value itself, right? So these are the basic 2 points. I hope you are getting this point. Now I have also given a balance sheet. Just I'm not showing you the amounts, just I'm telling you what I have done. See, if you closely watch, these are the black amounts which I have written in black. These are the copy pasted amounts. I have just copy pasted my balance sheet itself, plus my balance sheet as it is, plus I'll carry forward the balance sheet. I'll take over the balance sheet of the B Limited, but at fair value. Whatever the building value is, I will take over at fair value. So I have written the fair value over here, which you can see 280, 70, 50, 140. It was clearly given to you, right? It was clearly given to you. Please don't forget that you also have to record a PC. What is PC? Purchase consideration. What I paid to you? I paid 380, right? From where did I pay? Obviously from bank. So I have to deduct this 380 from the bank. And 40,000 I have taken from it, right? Okay. What was the value of goodwill? I have just added new value goodwill, which was asset 28,000, and I have added NCI. If you can closely watch, I did not take your equity and other equity. There is capital and other equity. I haven't taken this. Rest, every balance sheet, every item of the balance sheet will be taken as it is, and you just have to calculate it, right? Okay. Now, this was the first concept, right? So I have written over here, if you can closely watch, NCA was 95,000 over here, NCA was 88,000. These are the two methods, right? So just to take a few more questions for NCA measurement, because this is one of the important questions for NCA measurement. This can be asked for 5 marks and has been asked in the examination. It is not just because I am telling. This question has been asked in the examination. So I have given 3 examples for this, right? I have taken 3 examples for this. Let's try and calculate NCI from both the measures, right? Just take your calculators with me and try to calculate with me, okay? A Limited acquires 80% of B Limited by paying cash consideration of 120 crores. That means I have paid 120 crores for 80%. The fair value of non-controlling interest on the date of acquisition is 30. They have clearly given the fair value of non-controlling interest. So that means I don't have to calculate by cross multiplication. They have already given. If they have already given, you don't need to calculate. The fair value of NCI, they have clearly given. What is the fair value? It is 30 crores. Okay, 30. The value of subsidiaries identifiable net assets is 130 crores. INA is calculated as 130 crores. Determine the value of goodwill and past journal entry. See, obviously, in this question, they have clearly mentioned that NCI should be measured at fair value, but I'll be showing you both the methods. Okay. Now, what is the basic journal entry? So you'll say INA to bank, the first journal entry. The first journal entry. Can I say this is the PC amount? PC, right? So you'll pass the first journal entry as INA to bank. Only this much entry. What is INA? 130. What is bank? You have paid 120. You have paid 120. Also to NCI. Now NCI can be measured at 2 points. First is for 2 methods. First is fair value method. Fair value they have clearly given. You don't need to calculate by cross multiplying because they have clearly given the fair value. So I'll write 30 over there. Whatever the difference is becomes goodwill. Now, please tell me, is the NCI taken at fair value? The answer is yes. If it is taken at fair value, the goodwill will be full goodwill. The goodwill will be full goodwill, not partial goodwill. Okay. But was there any other concept also? The answer is yes. And goodwill, NCI can also be measured at PSNA. That is proportionate share in net assets. How will I measure it? See, it's very simple. INA is 130 crores. Right. So I'll say 80% is mine, 20% is yours. 20% comes to 26. So how will I measure it? It is INA to bank to NCI. So NCI will be measured at 26. I have paid 120. INA was 130 and this will be the goodwill. Now this goodwill will be treated as the partial goodwill, not the full goodwill, because I have measured NCI at PSNA. I have measured NCI at PSNA, right? So it was clearly given. Why did I not use the cross multiplying? Because the answer was clearly given to you. So I cannot use the word cross multiplying. Even if you cross multiply, you are getting the same answer, but you don't have to cross multiply. Why? Because the answer was clearly given to you. Okay, yes. So if you can clearly see, I have given you both the methods, NCI at PSNA, NCI at fair value. You can clearly see 20 and 16 in this case, right? So whenever we use PSNA, it is partial goodwill. Whenever we use fair value, it is full goodwill. Okay. Now this is the second question. I'm just zooming in, and I'm giving you 1 minute to calculate this. It is very simple. I want goodwill from both the methods, at PSNA also and at fair value also. I want the value of goodwill. Yes, the question is right in front of you. Try to calculate. Try to calculate. Yes, I want everyone to answer. Please be quick because this is a huge Ind AS and I have to cover a lot of points in this. Okay. So what is given? Okay, so both the answers are given. Fair value 230, proportion 150. Okay, let's see. Yeah, so I'm getting both the answers correctly. Okay, so it is a good thing that you are being active and you are giving the answers. So it is very simple. Just follow the above principles and you will be getting the answer, right? So this question, this type of questions are asked for 5 marks and sometimes asked for MCQ for 2 marks only, right? So both can be asked. Obviously, if any one is asked, it will be asked in MCQ. If both are asked, obviously it will be asked for 5 marks, which is very simple. Okay, next. Okay, next is a question for GBP. Again, the same question I'll be discussing together. A Limited acquires 80% of B Limited by paying cash consideration of 400. So can I say cash paid is 400. The fair value of NCI is 100 crores. It is clearly given. Fair value of NCI. So you don't need to cross multiply because it is clearly given to you 100 rupees, 100 crores. The value of subsidiaries identified net assets is 520. INA is 520. So again the two methods. First I'll calculate by fair value. It is nothing but INA to bank, right? Asset to bank. INA to bank. What is INA? INA over here, it is 520. How much did I pay? 400. How to measure NCI? It is clearly given. It is fair value. Fair value is 100 given to you, right? The difference comes to in credit side. And when I say credit, you will have to write GBP. You have to write GBP 20. Right? Okay. What if it was measured at PSNA? PSNA, the entry remains the same. INA to bank to NCI to GBP. The only thing is NCI will now be measured at whatever the INA is 520 into 20%. So you'll be getting the answer as 104. Instead of 100, you will measure at 104. So these are the answer. You can clearly see. So gain on bargain purchase is 16 over here and gain on bargain purchase is 20 over here. So wherever the difference are, you can easily calculate, right? Now, this I have given just an overview of what you have to do in Ind AS 103, right? Each and every time they will be focusing on NCI measurement. So NCI, there are two methods for it. First is PSNA and the second is through fair value. Now, which method you will follow? If nothing is given, apply the first principle, that is apply by PSNA. If nothing is given, just assume, give an assumption, assuming NCI is measured at PSNA and you will calculate the partial goodwill over there. Okay, fine. So these are the basic points which I have covered. I hope the point is very clear till here. Now, moving ahead. See, since this is a huge Ind AS, what I have done is I have taken a few points, then I have given again a summary. again few points, again summary, again few points, again summary, so that it will get carry forward with you, right? So I've taken revision and revision and revision in the revision session only. So I've taken a lot of revision in the revision itself. Okay? So please pay attention on this. Step acquisition. Now, what do you mean by step acquisition? This is one of the important point. Can be mixed in each and every question. Okay. Now, what is step acquisition? Step acquisition means I have not taken over directly 50% or more than 50%, but I have taken in parts. For example, let's say I have taken 20% of B Limited 2 years back. 20% of B Limited 2 years back. Obviously, when I say 20%, it is not holding. I'm not the holding company, but can I say if it is more than 20%, obviously it can be an associate. So in my books, if I am A Limited, I have taken already investment in associate over here. Obviously, I must have followed equity method. Now, what is equity method? That you will learn in associates itself. That is Ind AS 28 and 111. Now, investment in associate, let's say 20% of B. 20% of B, and it was purchased at 400. Example, it was purchased at 400. Now, what I have done is I have purchased further 40% now. 40% now. 40% for rupees, let's say 1350. 1350 is what I paid. So, can I say I have paid 1350 plus this 400 to acquire you, right? But this 400 I did not pay today. I paid 2 years back. So what I have to do is I have to book profit for this one. What do you mean by booking profit? See, I have purchased 20% 2 years back. What is today's value on the date of acquisition? That is, bring this investment at today's fair value. That is on DOA, fair value on DOA. DOA is nothing but date of acquisition. What you have to do is you have to book the profit or the loss. Loss may be very rare, but obviously if it was loss, why will I take over you? I found some benefits in your company and that's why I acquired more percentage, right? So it is known as step acquisition. What you have to do, it is very simple. Just book the profit right now. Let's say the fair value comes to 600. So what I'll be doing is I'll just book the profit of 200 right now by increasing the value. So what is the value in this scenario? It will be investment in associate, that is investment account debit to P&L. I'll book the entire profit of 200. Now I will say I have not paid 1350 plus 400 because in today's value it was 600. So the PC amount, that is the purchase consideration, will be treated as 1350 plus 600. The purchase consideration will be treated as 1350 plus 600. And now can I say it is no more an associate for me now because I became the holding company now. I will not record only 20%, but I will be recording all your 100% assets and give 40% to NCI because I am the 60% owner now. So this is known as step acquisition. It is very basic. See, what you have to do is you have to book profit right now. You have to book profit right now. How will I book the profit or the loss? By bringing the investment value to the fair value on the date of acquisition, not the previous year, that is fair value or 2 years back. No. It is, you have to take the fair value on the date of acquisition, the date when you are acquiring the 40%. So bring this value to the fair value at today's date, and then you will say that I have paid 1350 and 600 to acquire 60% of yours. That means first book the profit. So to better explain this concept, I have given an example. Please pay attention on this example. On 1/4/20, A Limited acquired 25% of B Limited for rupees 400. So A Limited has acquired 25% only. So can I say 25% is not holding, 25% is an associate. So I paid 400 for it. Okay. On 1/2/21, that is almost after 1 year, almost after 10 months. Okay. A Limited acquired 45% of B Limited for 1000 crores and established control over it. Now I have purchased 45%. Can I say 45 plus 25? I am the owner of 70% now. Right. Obviously, I cannot say I have paid only 1000. No. I have paid 400 2 years back also, yeah, or 10 months back also. What I have to do is I have to consider this 400 at today's value. What is today's fair value? I'll book profit till that. So the fair value of previously owned 25% was 600. So what I have to do is I just have to bring this to 600. That means I will book profit of 200. Now I can say I have paid you this 1000 and this 600. That means I paid 1600 for you. Okay. The fair value of INA was 1200. The fair value of INA was 1200. Now, how will I record? See, it's very simple. The answer is INA to bank, right? The answer is INA to bank. What was the INA? It was 1200. True. It was 1200. Okay. What was the value of bank? But how much did I pay you right now? I paid you only 1,000. But was this only the PC? The answer is no. I also gave you my previous investment. That is, I have to close my investment, right? Investment as a debit balance. It is no more an associate for me now. It is no more an associate for me. So I have to close this associate. So since it was my investment asset, asset as debit balance, to close it credit balance, but I'll close it 600. Why 600? It is very simple. I told you today's fair value. Okay. 2. NCI. Assuming it is measured at PSNI. Assuming it is measured at PSNI. So how to calculate PSNI? It is very simple. 1200, that is the value of INA, into whatever the person NCI is holding. Can I say 25 plus 45? I am the holding of 70%. 30% belongs to NCI. 30%. So it comes to 360. It comes to 360. So whatever the difference is becomes goodwill. Now, can you please tell me, is it full goodwill or partial goodwill? The answer is partial, because I have taken proportionate share in net assets, right? NCI is measured at PSNA and therefore goodwill will be partial. So this is the answer. But I cannot pass only this entry. I have to pass one more entry because of the profit booking. So the investment entry was investment in associate to P&L, 200 rupees profit booking. First, I'll book the profit. That means what happened is initially my balance sheet already had an investment in associate of how much? Of 400. I have to bring this investment to 600. That means, can I say increase the value of investment? Yes. Obviously, the value of investment is increasing and asset is increasing. It is a gain for you, and that you have to book the profit right now. So what you'll do is you'll increase the investment to 600, and now you will say it is no more an associate now because you are the holding now, and therefore you need to close this associate. By closing, you have to credit it. You have to credit it, and now this will be termed as the amount of PC. That is the purchase consideration. I never paid only 1,000, but I paid 1,600 in today's value, right? This will be termed as PC. So you can clearly see I have given these two journal entries, and these two including will give you PC. So investment to P&L first entry, and next is acquisition. Assuming it is the NCI is measured at PSNI, right? Okay, moving ahead. Okay, now please pay attention on this second example. Why? Because I don't know why, but the institute has asked this question for 14 marks. Obviously, this is the concept. The immediate next question was asked for 14 marks. 14 marks, and that question can be solved in 3 to 4 minutes only. I don't know how the institute has given 14 marks for this question. It is that simple, very simple, and it can be solved in 3 to 4 minutes. That too, I'm telling the maximum amount, that maximum time, 3 to 4 minutes. Okay, so this is very simple. Please pay attention on this. See, I'll first explain you what is equity method under Ind AS 28. So basically, equity method states that whatever, see, if I am A Limited, I am having an investment in B, that is investment in associate. I am having 25% of B, right? That means whatever B will be doing, if B value, if B generates a profit of let's say 1,000, I will say 25% belongs to me. I'll add 25%. Okay. If B Limited revalues the asset, I'll say 25% belongs to me. Okay. If there is any exchange difference of B Limited, I'll say 25% belongs to me. That means whatever B Limited is doing, I'll say 25% belongs to me, because 25% I am the owner. So whatever B is doing, 25% belongs to me, right? This is the very first point. Now, what you have to do is, please pay attention. I'm just giving the concept. This will be better understood with the help of an example. Okay, so just please pay attention over here. Now, what I'm telling you is, A Limited had already 25% stake in B Limited, and he purchased it for 6,000. 6,000. It was previously purchased, right? Plus, what he did is share in profits of 1,000. That means B Limited earned 4,000, and 25%, that is 1,000, belongs to me. Okay. There was also exchange difference in OCI. What B Limited did is it made an exchange difference, that is exchange profit of 2,800. 2,800, 25% belongs to me, and that is 700. Next, share of revaluation reserve. What B Limited did is B Limited revalued the PP. So what I'll do is 25% belongs to me. So I'll make it 200, right? And similarly, this 200 and 700 will be FCTR, that is foreign currency translation reserve, because it is exchange difference. This will be covered in Ind AS 21, and revaluation reserve, it is covered in Ind AS 16, that is PP, right? So that means if I value the asset, I also have to create a liability of revaluation reserve. Similarly, if I'm giving a share in OCI, that is exchange difference, I also have to create FCTR. this will be covered in under in Ind AS 21. I hope everyone has studied that, foreign exchange, right? If not also, then also it's not to worry, because this is only the point. This is only the one point which is covered under in 103. Okay. Now, so you have valued at 7,900. What you have done is you have valued at 7,900, right? By giving these two entries over here also. Now, what I am telling is I acquired more. Obviously, this will not be there now, because obviously I need to remove this investment in associate, because I'll be holding company now. Can I say if I'm removing this, I also have to remove these two. Because if there is no asset, there can be no liability on it. So, respective Ind AS I have to follow. What does this Ind AS do? So basically, this is a 4-step answer. 2 steps I have already taught you. What is the first step? Book profit by bringing this 7,900 to current fair value, as I told you right now. Just book the profit right now. And second is acquire. When I acquire, I'll say 2 bank and 2 investment together will form PC. That is the purchase consideration. What are the 2 more steps? You have to remove this FCTR. And where this FCTR will go, you just have to follow that. Just follow the blue line over there. It will be reclassified to P&L. Why? Because Ind AS 21 says that. The effects of change in foreign exchange rates. And revaluation reserve, if you remember, I taught you a few days ago, that is, I have already taken the revision. Revaluation reserves are never reclassified to P&L. They are directly transferred to retained earnings, because it is always OCI and R. That is non-reclassified, right? That will not be reclassified, and you just have to transfer revaluation reserve to retained earnings. That means 4 journal entries and 14 marks were provided to you. Now, I have taken an example on this. Please pay attention over here. See, this is the exact same question, which is question number 11 from my notes, from my regular notes, which I am taking. This was copy-paste question in your examination, in the recent examination. Copy-paste, not even the values have been changed. Okay, so please pay attention. On 1st April 21, PQR Limited acquired 30% of voting rights of XYZ for rupees 8,000 crores. That means I have only acquired 30%. Can I say it is an associate now, because it is not holding? And what was the date of acquisition? On 1st April 21. Okay, for rupees 8,000 crores. That means to acquire 30%, I paid 8,000. PQR Limited accounts for investment using equity method. Obviously, each and every one uses Ind AS 28 if it is associate. At 31st March 2012, PQR Limited recognized the share of net assets, net asset changes of XYZ using equity as follows. What they have done? They have given share of profits, obviously 700, share of exchange difference in OCI 100, and share of revaluation 50 rupees. That means what they have done is revaluation reserve is also there and exchange difference is also there, which were through OCI. So the carrying amount becomes this 8,000 plus all these. So you can see it is valued at 8850, 8,000 plus 700 plus 100 plus 50. That means it goes something like this. In your balance sheet, over here, you have investment in associate. What was the value of investment in associate you measured? It was 8,000. Okay. Did you on the profit? Yes. So profit was 700. It was not my profit. It was the entire profit of the company, of which 30% is mine. Okay. Next, revaluation reserve was there of 50, or else I'll say exchange difference first. Exchange difference of 100 and revaluation reserve of 50. Total of 8850. Right? These two were categorized in OCI because of the unrealized incomes, right? Revaluation reserve is also unrealized and exchange difference is also unrealized. Okay, fine. Moving ahead, there was also FCTR and there was also revaluation reserve, because you also have to create a liability against this. So it was 150 over there. So what are the 4 steps I have taught you? The 4 steps are bring this value to fair value first and then acquire. These are the 2 steps. And then you just have to close these 2 values. That's it. This is what you have to do. See, over there now. On 1st April 21, PQR Limited acquired the remaining 70% of XYZ for cash of 25,000 crores. That means I paid 25,000 crore extra. That means I have to acquire. Okay. The following additional information is given. Fair value of the 30% interest already owned is 9,000. That means I have to bring that 8850 to 9,000 first. This is the first entry. Fair value of XYZ's identifiable net assets is 30,000. They have clearly given to you. Okay. So can you please tell me what is the first profit booking? The profit booking will be worth 150, right? Because 8850 was there. So the profit booking will be investment in associate to P&L. So I have to book 150 now. That means, can I say I booked a profit and therefore this value becomes 9,000 now. And now I'll say I'll take over your business now. How will I take over the business? It's very simple. INA to bank. INA to bank. To the previous investment. Investment in associate. How much did I pay you? I paid 25,000. What was the previous investment? It was 9,000. Right? Because the current value is 9,000 now. And what was the INA given to you? INA was given to as 30,000. But this 30,000 does not belongs to me because I have taken 70%. Okay. Oh, sorry. It belongs 100% to me because 30 and 70 was 100. So there is no NCI because 100% belongs to me. NCI is nil over here. 30% I previously took and 70% I now took. So 100% belongs to me. So whatever the value is becomes goodwill, and goodwill comes to 4,000, right? But this is not the end. These are the two entries which are done. I hope the point is clear till now. 2 points. But the 2 points are you have to close this also. So where will this FCTR go? It will be reclassified to P&L. And where will this revaluation reserve go? It will directly transfer to retained earnings. So these are the two entries, if you can clearly see. FCTR will be transferred to P&L because it will be reclassified to P&L as per Ind AS 21. And revaluation reserve will be transferred to retained earnings. Now, only you have to write these 4 entries, and it was asked for 14 marks. I don't know how come, but still they have asked 14 marks, and this was the ultimate simple question which can be asked ever for 14 marks. Okay, so this was one of the easy questions. It was step acquisition. Next. Now, what we have started is purchase consideration. To understand what is purchase consideration, so I'll be giving you a lot of examples on purchase consideration, what to include in purchase consideration. So we have, as of now, I've added only 2 things. I can pay through cash, that is bank. I can obviously take investment in associate. It is known as step acquisition. Step acquisition. Okay, these are 2 things which are to be included in PC. Okay, what is the third thing? Contingent consideration. What do you mean by contingent? Contingent means which I may give you. It is not I will surely give you. For example, let's say you are B Limited, I am A Limited. I am the holding one. I am acquiring 80% of your company. I gave you, let's say 10,000 crores. 10,000 crores to acquire 80%. And I also told you that if your company will now perform good, that is, if your company earns a profit of 500 crores in the next year, I will pay you 5 crore extra. Now, can I say that is contingent? That is not sure because it is depending upon the further conditions, right? Whether I will pay you or not is not sure. So in that scenario, it is known as contingent consideration. That means you are not very sure whether you will pay or not. It depends upon the conditions, whether fulfilled or not. Okay. Now, the acquirer, what we have to do is we have to show it as a provision because I might pay you, right? I might pay you. Please make sure you are not taking any probabilities consideration in this. You don't have to take any probability. And how the contingent consideration will be measured? It will be measured on the fair value on DOA. Now, they will confuse you a lot. They will give you 2 to 3 fair values. What you have to do is you just have to consider the fair value on the date of acquisition. Whatever the fair value is, that means if I say I'm purchasing the asset, that is purchasing a business, so I'll be taking INA to bank, right? Obviously to NCI. I'll give you something to NCI, right, also. But the point is I'll also create a provision for contingent consideration. And this both together will be termed as PC. This is PC. I'm paying you plus I'll pay you something. But you don't have to take 5 crores because I'll be paying 5 crores. What you have to do is you have to take the fair value on the date of acquisition. Today's fair value. Let's say today's fair value is 2 crores. So you just have to take 2 crores. How will you get? It will be given to you. You don't have to calculate anything. It will be clearly given to you. Please make sure you're not taking any other fair value. You just have to take the fair value on the date of acquisition. Plus you don't have to consider any probabilities for it. Okay. Moving ahead. So I have given you. Plus there are 2 points in it. I have also given a summary of this. So the acquirer shall recognize the fair value of contingent consideration at the acquisition date. The acquirer shall classify an obligation to pay contingent consideration as an equity or as a liability on the basis of Ind AS 32 financial instruments. So you don't have to worry about that. It is very easy. In short, the current fair value become part of PC. So you have to take the current fair value, that is today's fair value, as the part of PC. So you can clearly see INA to bank to provision, and together they are known as PC. But what is the difference? See, Also, I have taken a concept question on that also. I have already taken a question on contingent consideration. Now, what if you are paying it in cash or variable number of shares? That is, if you will pay, let's say I told you, if your company achieves a target, let's say I took over 80% of that, I paid 10,000 crores to you. Then I'm telling you, after 1 year or after 2 years, I will pay you. If your company achieves a profit of 5 crores, I'll pay you 10,000. Let's say 1 crore. If your company achieves a profit of 200 crores, I'll pay you 10 crores. If your company achieves a profit of 300 crores, I'll pay you such amount. That is, it is not fixed, it is variable. Or else I'll tell you, if your company achieves a profit of 5 crores, I'll give you 1,000 shares. If your company achieves a profit of 10,000, I will give you 2,000 shares. If the profit is achieved for 15,000 crores, I'll give you 3,000 shares. That means I'm giving you not the fixed number of shares, but it is varying, right? It will vary. So first of all, on day one, what will you do? You have to measure it at the fair value and include in the value of PC. This will be PC. At the year end, what you have to do? You have to remeasure through P&L. For example, let's say on the fair value on today's date, I promise you to pay 5 crores after 3 years. But today's fair value is 2 crores. So I will obviously record it 2 crores. Next year, the fair value becomes 2.3 crores. It will be given to you. So you don't have to take 2.3 crores. What you have to do is, you just have to remeasure, because it was variable number of shares, right? Variable number of shares or cash. So if it is variable, what you have to do is, obviously my liability was 2 crores, but now I have to pay 2.3. Can I say it is a loss for me? Yes. So just increase the value of provision through P&L. So the entry will be P&L to provision 0.3. Okay, what if the value reduces, the fair value comes to 1.8, obviously book profit them. So it will be provision account debit to P&L 0.2 if the value drops to 1.8. That means you have to remeasure it. But what if I gave you the fixed number of shares? I told you I will be giving you, if you achieve this profit, let's say I took over 80% by paying some amount, and I also told you, if your company performs good and earns a profit of 500 crores, take 1 lakh shares from me. I gave you the exact number of shares. 1 lakh shares I will give you. So if it is 1 lakh, that means it is based on equity, and equity are never remeasured, and therefore obviously you will include in PC on day one on fair value, and year end you will have no change. That means you will still continue to be as it is. That means it will not be remeasured, because Ind AS 32, or you can say 109, says that equity is never remeasured at the year end, right? So the summary is, if you are giving cash or variable, you will remeasure every year, but important point is, you have to include in PC at what value. Even if it is fixed, even if it is variable, you have to consider it as a part of PC. But how will you consider? You will consider at the fair value on the date of acquisition. Clear? Okay. So contingent consideration also becomes part of PC. Moving ahead. Okay. So I've given a question, please pay attention. Company A and Company B are in power business. Company A holds 25% of equity shares of B. On 1st November, Company A obtains a control when it acquires further 65% of the company share. Now, can I say, first there was 25% and then I acquired 65%. So can I say this is step acquisition? So step acquisition, 2 methods. First point, book profit and then include in PC. Okay, fine. Consideration. What was the consideration paid? I paid cash of 59 lakh and 1 lakh shares were issued. I'm also giving you 1 lakh shares. Okay, you can give it in number of shares also. The market price of company A on the date of issue is 10 rupees. That means I'm giving you 1 lakh shares at rupees 10. So what is the amount which I'm paying? I'm paying you through cash, 59 lakhs. I'm paying through shares, equity shares, 10 lakh rupees. 1 lakh shares into 10. Right? Moving ahead. So this is PC. Contingent consideration. It is clearly given. Company A agrees to pay additional consideration of 7 lakh if, the word is if, it is not sure. I will pay you 7 lakhs. So can I say it is paying in cash? So it is cash or variable. Every year and it will be remeasured, right? Okay. The cumulative profit exceed rupees 70 lakh of the 2 years. That means cumulative profit of both the years comes to 70 lakhs. At the acquisition date, it is not considered probable that the extra consideration will be paid. The fair value of the contingent consideration is determined at 3 lakh at the acquisition date. So can I say it is fair value on DOA? Do I have to consider this? The answer is yes. You have to consider this. So over here, DOA, that is contingent consideration, will be 3 lakh rupees. And year end, year end, if it becomes 3,20,000, I have to book a loss of 20,000. If it is 270 after year end, I have to book a profit of 30,000 and so on. That is, it will be remeasured because it is paid in cash. Okay. Transaction cost. I forgot to include this. Yes. Transaction cost. Transaction cost will never form part of PC. When I acquire asset, I obviously add to the asset. But when I am acquiring a business, transaction cost is not a part of P&L. If I'm paying anything as a regulation fees or something for the legal fees or anything to advocates or something, that will be transferred to P&L. It will not be added as a part of INA or PC. That means if I'm paying 10,000 crores to acquire 60% of you, and I paid 5 crores for legal fees, this 5 crore is not to be added as a part of PC. It will be expense. That is, it will be transferred to P&L by passing this entry. But students remember this thing, but they forgot to give this impact in balance sheet. You also have to give this balance sheet. How will you give the impact? It is very simple. See, if you are paying, obviously your bank get reduced by 5 and also your profits get reduced by 5. So you have to do this entry in the balance sheet itself. Okay. Now, over here is the transaction cost. Is the transaction cost to be treated as part of PC? The answer is no. It will be transferred to P&L. Next, NCI. The fair value of the NCI is determined as 7,50,000 at the acquisition date at the market prices. Company A elects to measure NCI at fair value. It is clearly given to you. So you don't have to calculate any cross multiplication. You can directly take this 7,50,000 as NCI. Previously held investment. Remember that step acquisition, 25%. In shares for several years. At 1st November, the investment is included in A's balance sheet at rupees 6 lakh, accounted for using the equity method. The fair value becomes 20 lakhs. So can I say it is now showing in the balance sheet at 6 lakh, but the fair value is 20 lakhs. So I need to book at 20 lakh rupees. That means 14 lakh profit first. Okay. The fair value of identifiable net assets is 60 lakhs, determined in accordance with Ind AS 103. So what you have to do is, can I say investment is also a part of PC? Investment and associate, it is 20 lakh rupees. So the total PC comes to 50, 69, 72, 92. 92 is the total PC. Obviously, you need to book profit of 14 lakh also. So you can clearly see, I booked the profit of 14 lakh first. Then at the acquisition date, it was INA to bank, the first entry. To NCI, fair value was clearly given. To equity share capital, because I gave you 1 lakh shares. To investment, it is the previous investment. And to provision for contingent consideration. Together, they form part of PC. That means, till now, in PC, I have taken the bank figure. I have taken the shares figure. I have taken the contingent consideration and I have taken the previous investment. Right? These 4 form part of PC. Moving ahead. Acquisition cost I have not added to the PC, but it will be transferred to P&L. So please make sure you are not transferring any acquisition cost to the PC part. Okay. Next. Now, the next point which will be added to PC will be SBP rewards. Now, what are SBP rewards? That is share-based payment rewards. What are exactly share-based payment rewards? See, basically there are 2 scenarios. One scenario I'll be taking it right now and the other scenario I'll be taking at the end, right? So what are SBP? See, I will not give you the formula first. I'll explain you in short first. Okay. So over here you can see on 1/4/23. Now, what are SBP rewards? First of all, I'll tell you. It is basically covered under employee benefits, right? Sorry, not employee benefit, it is share-based payments, Ind AS 102. Now, if it is, let's say I am A Limited, you are B Limited. Your company has already given the SBPs, that is share-based payment rewards to employees, that is ESOPs, right? So over there, obviously, there will be an expense for you. So since you have already given the expense, B Limited announced SBP, but it was not my scenario. You have already given to them, right? So B Limited booked 2 years expense. You have already booked 2 years expense. And what was the option? You were having 100 employees, and for each employee, you were paying 200 options to them. Okay, the fair value of the option was 50, and the life was 5 years. Now I took over. See, how many years have been passed? Okay, it was 25, sorry. Now, A Limited took over and replaced. The word is replaced. So basically, the 2 scenarios are SBP rewards replaced or not replaced. What do you mean by replaced? Replaced, I'll tell you. See, I took over your company. Now, I told you, okay, whatever your obligations are, I will fulfill them. That means, I told your employees that you continue to work with the company B Limited, and whenever you will complete the complete term, the 5 years, I will give you my shares. B Limited will not give you shares. I will give you my share. That means I'm replacing his liability over my liability. This is known as replaced. What is not replaced? Non-replacement is your B Limited has the employees. I'm telling them that B Limited, that employees you have to give the B Limited shares only. I will not give you my shares. B Limited will only give them their shares, right? So each and every time when the question asks, they will always give you replaced. They will always give you replaced. Not replaced will not be given. Not replaced, a separate question can be framed. Okay. So I have also taken over that at the end. So I'm talking only about replaced. So what you have to do is, whatever the term has been already expired, the original term was 5 years, but 2 years have already been passed, 3 years are remaining. So what you have to do is, you have to take 100 into 200, that is the number of employees, it will be clearly given to you. Whatever the fair value was there, and of the 5 years, 2 years have already been passed. 2 years have already been passed. So that 2 years will be included as a part of PC. That 2 years will be included as a part of PC. Now, what about the remaining part? The remaining part will be expensed out by A Limited because I am taking over all your liability, right? So see, it is something like this. This is A, this is B. This is SBP over here only. So I will tell you, it will replace now. What I am telling the employees of B Limited, the B Limited employees, I will give you my shares. That is, A will be issuing shares. So this is known as replaced, right? This is known as replaced. Okay. Now, to better understand, I've given an example. See, over here, I'll give you the example first, and then I'll explain you the formula. The formula is tough, but the explanation is very simple. See, Green Limited acquired Pollution Limited. As a part of arrangement, Green Limited had to replace the Pollution's existing equity share settle reward. Replace. The original awards specify a vesting period of 5 years. Originally, it was 5 years. Okay. At the acquisition date, Pollution Limited employees have already rendered 2 years service. That means, of the 5 years, 2 years have already been passed out. Remaining are 3. Now, as required, Green Limited replaced the original rewards with its own share-based payments. Under the replacement rewards, the vesting period is reduced to 2 years from the date of acquisition. That means I now reduced it to 4 years. 2 years have already been passed and more 2 years I'll be taking. Okay. The value of the rewards as on are follows. Original reward was 500, but the replaced reward is 600. Okay. Now what you have to do? Of this 500, 500 into whatever the time has been lapsed. What is the time lapsed? 2 years. Of what years? 5 years. So this comes to 200. 200 is known as the pre-combination period. That means before combination, before acquiring you have already booked the expense. So this amount will be treated as part of PC. 200 is PC. Okay. Now, ignore this. What is the replaced reward? Now to, B Limited employees, I told them I will not give you 500, I will give you 600. I will give you more shares, 600. So can I say my expense will be 600? And of this 600, 200 is already included in PC. Remaining 400 is treated as post combination. That is after acquisition, post combination. This 400 will be expensed out, transferred to P&L. Not today, but over the period of life, over the remaining life, over the remaining period. What is the remaining period? The remaining period is 2 years because originally it was 5 years, but while replacing it, I reduced the figure to 4 years. So I have taken only 4 years over here. So remaining 2 years, it will be expensed out. That is, it will be transferred to P&L as 200 and 200. This is not important. This is important. This is important. So how to calculate the pre-acquisition? It is very simple. How to calculate the pre-acquisition? See, original, whatever the value was, original fair value of options into time expired upon total vesting period. Total vesting period. Now, there is a twist over here. Most of the times, total vesting period will be 5 only. But if at all, the life is increased. See, over here, I reduce the life to 4 years, right? But sometimes the holding company can increase the life. That is, instead of 5, they can give 6. So I have to take vesting period original or revised total, whichever is higher. I have to take the higher period, not the lower period. So basically, in this scenario, the original period was 5 years and the revised period was 4 years. So whichever is higher, 5. But if at all, they give you 6 years. The replaced awards is for 6 years. At that time, you have to divide by 6 and not by 5. And whatever the amount comes over here, total replaced award minus this amount will transfer to P&L. This will be the transfer, right? So I have taken a basic question over here. and I'll also be taking this with another example in the big questions. Okay, so you can clearly see what was the initial value. Initial value was 500. Initial value was 500. What was the time already spent? 2 years. Divided by total life is 5 years. 5 or the revised life is 4 years. So I've taken the 5 years, whichever is higher, including PC. Including PC. Next point, post combination. Now I have to pay 600. Of the 600, 200 is already including PC. So the 400 will be booked in remaining life of 2 years. This is the answer. You have to present it like this only. You just have to write this, right? Replace rewards. Moving ahead. Moving ahead. Now, if you can see the formula, total fair value of the original reward, whatever the answer was, into expired period, divided by original vesting period or replaced vesting period, whichever is higher. Whichever is higher. Next, total fair value of replaced reward, whatever the new value was, minus the pre-combination SBP. And this will give you the pre-combination and the post-combination answers, right? Important is pre-combination. This will again be taken in the big questions. Okay, next, moving ahead. Now, shares issued for PC. Can I issue shares also? The answer is yes. But there are two mistakes which the students make in this scenario. I'll be explaining about. First of all, just look at the scenario. A Limited, you can see 10 lakh shares, 100 lakhs and rupees 10 is the face value. A Limited. It acquires 70%. 70%. And he says, I will give you 1 for every 2 shares. Obviously, if I'm acquiring their shares, I will give them 1 share for every 2. So in this scenario, the first mistake made is they say, sir, you are paying 5 lakh into 1 by 2. But this is incorrect. Why incorrect? Obviously, if I am paying through shares, I will first ask you how many shares are there. So you will say, sir, I am in my balance sheet, there are 5 lakh shares. Okay, 5 lakh shares are there. And I'll be paying 1 share for every 2. 1 by 2 is also right. But did I take 100% of yours? No. The answer is I have only taken 70%. So what you have to do is you just have to multiply by 70%. Into. I am giving you my shares, right? So obviously my fair value will be taken. So my fair value, that is fair value of A, is 40. So I will be taking at 40 rupees. This will be included as a part of PC. That is, I'll be giving you 5 lakh shares, not completely 5 lakh, but 1 for every 2, that is into 1 by 2. I'll not be giving to 100%. I'll be giving only to 70%, right? Only be giving 70%. This is one of the important point over here. And since I'm giving you my shares, obviously my fair value will be taken, not your fair value. My fair value is 40. So I'll be multiplying by 40. Obviously, whatever the answer comes, I'll distribute in 2 parts. Capital will be obviously 10 rupees and premium will be always 30 rupees. Obviously, the share price is 40, but equity capital always is face value 10. And therefore, the 30 will go to amount premium. Next. The amount of fair value, INA 95 fair value is already given. That is INA, net identifiable net assets is given. Now, what is the PC now? Obviously, I have not given you any cash, but I have given you shares. So the amount of shares will be, you have 5 lakh shares, I am giving you only 70%, 1 by 2 and 40, 70 lakh rupees. But when I'll write the journal entry, I'll write 10 rupees is capital and 30 rupees is premium. So capital comes to 70 lakh 50 and premium comes to 52 lakh 50,000. Now, this was the first mistake the students can make, 70% mistake. Second mistake which the students can make, if I ask you NCI at PSNA, you will say, so it is very easy. Whatever the INA is, give 30%. The answer is true. This is true. But when I will say measure NCI at fair value, what the student do is, they will say, sir, for 70% you have paid 70 lakh. So for 30% how much? But this is incorrect. You don't have to do like this because the value of shares are given to you. Do you have B Limited's fair value? The answer is yes. You already have the fair value. So how many shares? 70% I have taken. So can I say 30% are remaining? 30% matlab 1,50,000 shares. So for the 1,50,000 shares, each value is 25. And that is the fair value if measured at NCI at fair value. So over here, if you can closely watch, I'll say 1,50,000 shares into 25. 25 was the important point over there. So in at PSNA, right? So these are the 2 points, and this is how you will calculate. How to calculate goodwill is very simple. PC plus NCA minus PC plus NCA minus INA. This is how you will calculate. If the answer is positive, it is goodwill. If the answer is negative, it is GBP, that is capital reserve. I hope the point is clear till here, right? So what I have added bank shares, SBP. I've added the contingent consideration, and I have also added the SBP. Step acquisition. Okay, and the last part which can be included in PC is the deferred consideration. Right? Don't worry, I'll also give you the summary of this, so it will be very easy for you. Okay, this is the last point which will be included in PC. Whenever there are huge questions of 14 marks, obviously you have to just give a marking where to include, whether PC or INA. So I'm talking about PC only, deferred consideration. When acquirer promise to pay a certain amount in future years, not based on any condition. See, one is contingent consideration and the second is deferred consideration. There is a difference between contingent and deferred. Contingent is, if you achieve this, I will pay you. That is certain condition. So that is measured at fair value on the date of acquisition. But deferred means I will not pay you right now, but I will pay you for sure, not based on any condition, but after 2 years. So if it is very much sure that I will pay you after 2 years, for example, I acquired 70% of your company, 70%. I paid you 10,000 crores. And I also promised you after 2 years, I will pay you more 5 crores after 2 years, but not right now. So can I say it is a promised condition of 5 crores after 2 years? What I have to do is I just have to take it as the present value. I have to take it at the present value, just like the provision for restoration, if you remember in Ind AS 16. What you have to do is we just have to calculate at the present value. See, there are two different points. First is contingent and second is deferred. Contingent means based on certain conditions, so we have to evaluate fair value, and deferred means short, there is not based on any conditions. I will pay you after 2 years. You just have to take the present value in the PC calculation. So over here, if you can closely watch the example, A Limited took over B Limited and paid rupees 200 crores plus promised to pay rupees 10 crore after 2 years. Discount rate is 10%. Discount rate is 10%. That means provision, that is present value of deferred consideration. I will pay you 10 crores, but not right now, after 2 years. So the present value comes to 8.26 crores. This will be added as a part of PC. How to make the journal entry? It is INA to bank. INA to bank to NCI. Since I have taken 100%, took over B Limited. Percentage is not given. Obviously, it is 100%. So I took over by paying 200 plus provision for deferred consideration. Now, where will this provision be shown? Obviously, it will be shown under the head non-current liabilities. It is a long-term provision. So what you have to do is of this provision, remember the provision which you have to do of the Ind AS 16 provision for restoration. You have to unwind it. What is unwinding? What is unwinding? Just transfer the interest amount. That is nothing but opening, add interest, closing. Opening, add interest, less closing. So this will be the answer. So over here, if you can closely watch, 8.26 was the provision. At the end of first year, that is when the year will end, obviously I'll unwind it, that is add the interest. So the answer becomes this. Again, after 2 years, add the interest, the answer becomes this. So 2 years interest to provision. After 2 years, do you have to pay this? The answer is yes. So the payment entry will be payment entry, provision to bank. The payment entry will be provision to bank. This is the answer. I hope everyone is getting the point till here. Now, it's the time for revision of revision. What we have studied till now, it is a summary of purchase consideration. These are the important points which you have to remember. Please make sure you are making a note of this. Bank, can I pay you in cash? The answer is yes. Can I pay you in shares? The answer is yes. If I'm paying in shares, please don't forget capital and premium amount to separate it. I can pay also debentures, but debentures not included in any of the question, right? Can I make it a previous own investment? Yes, it is a part of step acquisition. It will be termed as PC. Book profit and include that investment in PC. First, we have to book profit. Okay. Deferred consideration, fair value or present value? The answer is deferred it, present value, because it is not based on any condition. Contingent, I will say on the date of acquisition, fair value, right? And future fair value are irrelevant for PC calculation. SBP, only the pre-combination period remains in PC, only the pre-combination period. So these are all the points which are considered in purchase consideration. You will pay in bank, through cash, through shares, through previous investment, through deferred consideration, through contingent consideration, and through SBPR. 6 points are there which will be covered in PC. So whenever you see a point, previous investment, deferred consideration, contingent, SBPR, it is always included in PC. Still now, I haven't given you my steps to follow the CFS. How to make CFS, I'll be explaining you. But obviously, since it is a huge Ind AS, you have to go step by step. You have to be a bit patient how to go till there. Obviously, it is a step-by-step situation. So I have only calculated how to calculate the entire PC, right? Okay. Now, what is the difference between business acquisition versus versus asset acquisition? I'll ask you one question. Okay. So the carrying amount is 4 lakh. The fair value is 5 lakh. It is clearly given to you. Amount paid is 11 lakh to acquire the above, and the acquisition cost is 20,000. Please tell me, if it is a business combination, if I have acquired the business, if I have acquired the business, how much have I paid? I have paid 11 lakh 80 and this 20,000, right? And this 20,000. What is the amount of PCA? If it is treated as a business combination, what is the amount of PCA? I'm asking every one of you. Please tell me the answer. If it is a business combination, what is the amount of PCA? I have paid 11 lakh 40,000, sorry, 11 lakh 80,000 to purchase 3 assets. Okay, so the point is, whenever I purchase, whenever I say it is a business combination, I always take over at fair value, right? So can I say I have taken the 3 assets of 10 lakh rupees, that is INA, if it is a business combination, and I have paid 1180, not 20, because acquisition cost should be transferred to P&L. Right? This is the important point. So the fair value, whatever the business acquisition is, I have taken 10 lakh rupees of your business. Obviously, if you remember, INA is always at fair value. So over here, if you can see, INA at fair value 10 lakh. To bank, I have paid 1180. The extra amount I have paid as goodwill. And the acquisition cost will go to P&L. This is a simple point. But if I'm acquiring the asset, you cannot say I have paid the extra amount as goodwill. No. Because if I ask you, B Limited has an asset in the bank, in the balance sheet, let's say building of 5 lakh, and you purchase it for 7 lakh, only the building, what is the journal entry you will pass? You will say building to bank of 7 lakh, right? You will not say, no, I have purchased 5 lakh ka building of at 7 lakh rupees, that means I have paid 2 lakh as goodwill. No, it is building to bank. Plus. If I say to acquire this, you paid 50,000, you will say that your building becomes 7.5. Can I say the acquisition cost becomes the cost of the asset? Yes, that means the acquisition will now be added to the cost. So can I say I have purchased 3 assets? For a total of 12 lakhs. So the entry will be asset to bank for sure. How much? 12 lakh. Now the important point is which asset? I have purchased 3 assets. So obviously I have to write the names: land and building, machinery and furniture. So this 12 lakh belongs to all these 3. How will I apportion it? On the basis of the fair value. And therefore you can clearly see over here, I have purchased PPE to bank 12 lakh, but what are the individual values of 12 lakh? So it will be divided in the fair value ratio. That means I have purchased land for 6 lakh, machinery for 360 and furniture for 240. That means if it is a business combination, INA to bank, INA is always at fair value. Acquisition cost will be transferred to P&L. But if it is an asset, it is asset to bank, the entire value, including the acquisition cost also. But how will I apportion into assets? It will be apportioned on the basis of fair value. This is the important point. Okay, next. I have given a few more examples. You can check over here. Asset acquired land and patents for rupees 180 crores. The fair value is 100 and the value is 50 crores. So I have acquired asset. 180 crores is the answer. I have paid. So the entry will be asset to bank. Right? I have paid 180. But in this asset, there are 2, land and building and patents. So I will apportion this 180 obviously on the ratio of their fair value. So over here, you can closely watch. 180 I paid and I will apportion it on the basis of fair value, which is 100:50. So land will come to 120 and patents will come to 60. Right? Okay. Second question. A similar question. But what they have given is 2 crore acquisition cost paid for land. Now, can I say they have clearly given it is for land? So you cannot apportion this to patent. Ideally, what is the mistake made by students over here? I have paid 182 and I'll apportion on the basis of fair value. Why? Because 2 crore is the cost of acquisition. Whenever you purchase an asset, obviously you add the cost to the transfer the acquisition cost to the cost of asset. But it is not the case. Since this 2 crores is specifically given for land, you will say 180 will be apportioned and this 2 crore will only be added to the cost of land, not the cost of patent. Right? Okay. The third scenario. What I have given? Asset acquired, land and patents for 80 crores, plus I have given you machinery. That means I have given you cash also, and I have given you machinery also. Can I say this is exchange? If you remember Ind AS 16, exchange principles. What were the three principles I taught you? In the order of preference. The first preference is I'll record the asset acquired at the fair value of asset given up. Is the fair value of asset given up is given? Yes. Obviously, I'll follow this. So the entry will be, first of all, don't look at the amount. First of all, just pass the journal entry. What is coming in and what is going out? Can I say land is coming in and patents are coming in? Two assets. Two, bank is going out, and two, machinery is going out. So the bank is 180 and the machinery is 20. That is 20. Now, the important point is, at what value will I record? The answer is first preference, fair value of asset given up plus cash paid if any. So the fair value is 330 and the cash paid is 180. Total of 210. 210 will be apportioned on the fair value basis, which is 100:50. 210 will be apportioned on the fair value basis, 100:50, and 140 and 70 will be transferred. Whatever the answer is, transfers to P&L, right? So this is the point. Again, this was covered in Ind AS 16, the first preference, right? Okay, this was asset acquisition. Okay, the next point. And now comes the important point, which is the second point, and that is known as identifiable net assets. What are identifiable net assets? INA. So INA includes a lot of points. I have explained it one by one, and then I have given the summary also. See, it is very simple. First, you have to take the PC part. PC is separate. What was included in PC? Remember, what was included in PC? It was bank, it was shares, it was previously held investment, it was deferred consideration, it was contingent consideration, and it was SBP. So basically 6 points were included in PC. For INA, there are 8 to 9 points. You have to study it one by one. What is basically INA? Take over all the assets and the liabilities at fair value. This is important. Plus, second, parent will also record those assets which are not recorded by subsidiary. For example, the subsidiary has a customer database which is self-generated. For example, the subsidiary business is to collect data. Obviously, if you go to a mall, there are many persons who will give you the form and they will tell you this is just a lucky draw ticket. If your number comes in, you will get so much of discount or so much this product, right? So what in that grid, what you do is you give your number and you give your contact number and the name and the email address, everything. That means this has been collected by the subsidiary. Now, since it is self-generated, he cannot record it. Subsidiary cannot record it. But can I say the parent has taken over? So I can say I am also paying for this database. So even if certain assets are not recorded by subsidiary in their balance sheet, the parent has the right to create, because this is nothing but intangible asset under under Ind AS 138. Under Ind AS 38, and 38 says that you cannot record an intangible asset which is self-generated. But if you purchase it, obviously you can record it. So can I say parent is purchasing the subsidiary business? Yes. So I can say the customer database is also included in that, and therefore it can also be treated as a part of INA, that is identifiable net assets. So apart from what is there in your balance sheet, outside your balance sheet, I also can take that also, right? Next, classification of assets in CFS. Sometimes it may happen that in the books of subsidiary, an asset is categorized as NCA, but it may happen that on the date of acquisition, the parent may include as current asset. It may happen. So whatever the parent feels that, obviously vice versa can also happen, that is CA can also be transferred to NCA. So classification, that is subsidiary company meets the definition of current as per parent, then CFS, it will be shown as current asset and not as NCA. Okay. Exceptions. Classification of lease cannot change. That means if subsidiary has shown as a finance lease, parent also has to show it as a finance lease. Second point, contingent liability. I'm not going in detail contingent liability. I'll give you the crux of that. See, basically this is Ind AS 37, but I'm not explaining you what is Ind AS 37 now, provisions and contingencies, but I'm just giving you a brief idea. If it is a present obligation for past events and the probable outflow is not and the outflow probable is not probable and amount can be estimated reliably, at that time it is treated as a contingent liability. So what we have to do is, subsidiary has recorded as something as a contingent liability, If in the exams nothing is given, then always assume it is a second condition and include it as a part of INA. For example, if the subsidiary has something, let's say on a subsidiary there is a case going on, and there are chances that subsidiary might lose it, and they have to pay rupees 5 crores, or else over here 3 lakh, over 3 lakh, right? So since it is not very sure, they have treated it as contingent liability. Now this will be treated as INA part. That means this liability will also be taken as the by the parent, and therefore it will be treated as the part of INA. Next, deferred tax. We have to calculate as DTA or DTL. When will you calculate? Whenever tax rate is given, at that time you have to calculate. How to calculate that? It is covered under Ind AS 12, that is income taxes. How will I cover? See, my way of teaching this point is through this point. See, please check. If you are checking for an asset, whether to take DTL or DTA, a lot of students face confusion in that. So it is DTA or DTL. So I have given a very crux answer, very simple answer. If you are starting with for an asset, so first check the carrying amount, that is the fair value for you, minus the tax base. If not given, that is the carrying amount for you, whatever the subsidiary's balance sheet has. If the difference is positive, create DTL. If the answer is negative, create DTA. Always check for asset, CA minus tax base, that is carrying amount minus tax base. If it is for liability, reverse it. Start with tax base and then subtract the carrying amount. You will get the answer very easily. The rules are very simple. If you are getting the positive amount, create DTL. If you are getting a negative amount, create DTA. Now, you might feel that, sir, this is very tough because we haven't learned. If you are a new student, if you haven't taken my lectures, obviously this you will not understand this. But I have taken it in practical examples, so that I'll be teaching you over there also. Okay? So carrying amount is nothing but the fair value. Tax base, it will be given to you, of if not, then the old carrying amount, whatever becomes the tax base. And then the difference, it is known as temporary difference. Minus into tax rate will give you the deferred tax. When you will calculate, whenever the tax rate is given, is deferred tax a part of INA? The answer is yes. See, I have started INA now. Initially we were studying PC, right? And now I have started INA. What is identifiable net assets? What to include? Obviously, if in your balance sheet all the assets and all the liabilities I will take over at fair value. Plus, what I am taking is, if there are any contingent liability in your balance sheet, that is outside your balance sheet, I will also be taking as a part of INA. If there is any deferred tax, obviously I will be taking that also. Next point. Employee benefits, it is not very important. It will be a plan asset or DBO. It is not very important, not even covered in your any of the question, but I'm just explaining you employee benefits. It will be transferred, it will be taken over as per Ind AS 19, which is employee benefits. Okay. NCA, this is one of the important points. NCA held for sale under Ind AS 105. How to take? You have to consider it as FLV CTS. What is FLV CTS? Fair value less cost to sale. That means, if at all you have an NCA held for sale in your balance sheet, let's say you are having at 5 crores and the fair value is 5 crore itself, but you will not take it 5 crores. You will take at fair value less cost to sales. Let's say the cost to sale is 1 crore. So you will be taking at 4 crores. You will be taking at 4 crores. NCA held for sale. Next. Indemnification asset. This is one of the important point. Indemnification asset. What is indemnification asset? See, let's say I'm taking your business. That is 80% of your business I'm taking over. But you already have an ongoing case on you. Someone has filed a suit against you. And obviously if I'm taking over, I'll have to pay that. In that scenario, subsidiary promised to pay something. Subsidiary told, okay, if we lose the case, we'll pay you so much amount. We'll give you so and so amount, right? That means it might be something like this. Subsidiary has a liability. Obviously, I'll be taking that liability in my books at fair value. Also, subsidiary promised to pay this 80%. So I'll be treating it as an asset, indemnification asset. That means this subsidiary will indemnify. That is, it will compensate for that loss, because that I have to pay 1,000, but this is for the case it is already ongoing, right? So in that scenario, 800 will be treated as indemnification asset. If I lose that, I will take 800 from the subsidiary. But sometimes subsidiary has not shown as a liability. Sometimes subsidiary has shown as a contingent liability. No problem. I'll still take that as a liability. And if it is promising, I'll take it as an asset, indemnification asset. But the note is, can I consider this as an can the parent consider this as contingent liability itself? The answer is yes. If there are only 10 or 20% chances of paying that, and you will not show it as a liability, you will show it as a contingent liability. So in that scenario, you will not show indemnification asset in the balance sheet. You will show it in the notes to account itself. That means if a liability is shown, only then the indemnification asset can be shown. If the liability is shown under notes to accounts, then indemnification also can be shown under notes to accounts. It will not be shown as a asset. But so the rule is, if liability is shown, then the asset can be shown. The second note on this is, asset cannot be greater than the liability. For example, the subsidiary has told me that they will pay up to 1500, but the liability is only 1000, so I cannot record 1500. I have to record maximum 1000. That means the asset cannot be greater than the liability. The asset cannot be greater than liability, because they have told up to 1500 will give you. They will not pay 1500. Obviously, whatever the loss is, they will give you, right? So the points are, if at all there is a liability in the subsidiary balance sheet, you will take it. If at all there is a contingent liability, again you will take it. And if at all the subsidiary is ready to pay me something, if this happens, they will pay us. So this becomes an asset for us. The amount will be receivable. So I'll show it as an indemnification asset, right? If the liability is shown in the notes to accounts, indemnification asset will also be shown under notes to accounts. Plus, if the asset is more than the liability, it cannot be shown. Asset maximum can be shown at the point of liability only. Okay. So this is the note. You can clearly see. If contingent liability is recorded by parent, then record the indemnification asset also. But if contingent liability is disclosed by parent, then indemnification asset will also be disclosed. Note, indemnification asset cannot be greater than the amount of liability. Okay. Now, so these are the 6 points. I'll be taking the revision. As I told you, it is a huge Ind AS, so multiple revisions are necessary. So I've taken revisions step by step. Okay. Next is reacquired rights. Now, what do you mean by reacquired rights? See, I framed an example. Please pay attention over there. Let's say we are A Limited and we gave a franchisee to B Limited for 10 years at 1500 crores. At 1500 crores, I paid you, right? Okay, there are 2 points on reacquired assets. One I'll be teaching you right now, and the other is at the end. So reacquired assets, B Limited, the franchisee is for 1500. Obviously, B Limited is shown as an intangible asset. Since A Limited is giving a franchisee to B Limited, it becomes an intangible asset. Okay. After that, B Limited will start using, and they will depreciate it year by year. Let's say the period of 10 years. So after 4 years, the value will drop to 900. That is 150 per year depreciation. After 4 years, 600 will be the amortization, and the franchisee cost will be 900, right? The value. And now what happened? I took over your business. Can I say this franchisee also I'll be taking over? That means this right which I gave you, and that already I am purchasing now. That is the right I gave you. I will purchase that right from you only. Now I will purchase at fair value, not 900, but at the fair value. Since it is your asset, I know it is your asset, and if you remember, I'll take your entire balance sheet at fair value. This was the terms which I have already discussed. I'll take entire balance sheet of yours at fair value. So can I say whatever is there in your balance sheet, I will be taking over at fair value. So even if it is the right which is given by me only, then also I'll be acquiring that at fair value, right? At fair value. So this is 1000, right? Okay. There is another point on that, but I'll be discussing later. Reacquired rights. Next is lease. Lease. You cannot change it. Will be taken over by the parent at fair value. That means if subsidiary is having an ROU and the lease liability under Ind AS 116, it will be carried forward by the parent as it is at the fair value. Not very important. Contingent asset will never be recorded, right? Okay. And now it's the revision of revision. It's the revision of revision. See, if you understand the PC and INA, every question you will be able to tally. If you understand PC and INA, what to include in INA and what to include in PC, I'll give you a brief summary again. Please pay attention. Lease classification, not very important. That is, the lease classification cannot be changed. It can come under MCQ, not very important. Contingent liability is important. treat as a condition 2. What is condition 2? Ignore that. Just ignore that. Contingent liability in the books of subsidiary. That is, if at all there is a ongoing case going on you, I will treat it as a liability. So while calculating INA, obviously what is INA? Assets taken over minus liabilities taken over. At what value? At fair value. So I'll just calculate it. Till now, the questions above were INA was ready-madely given to you. But now I'm calculating the INA. How will I calculate? I'll take your balance sheet. I'll take one balance sheet, fair value, then minus liabilities, fair value, and whatever the answer is becomes INA. Apart from that, if at all, in your balance sheet, there is, after your balance sheet, there is contingent liability. I'll also be taking that. So that part will also be considered as the INA, right? Next is deferred tax. How to calculate deferred tax? See, it is very simple. If this is your balance sheet and this is PP, I'm talking about the B limited, which I'm taking over, right? It is your company which I'm taking over. PP, let's say it is 100. But the fair value comes to 120. Fair value comes to 120. So what I'll be doing is, carrying amount is 120. For me, I'll take over at 120. But what is the tax base? Tax base was 100. The previous carrying amount in your books, it was 100. But I'm taking over at 100, right? So what is the difference? 20. Is it positive? Yes. It becomes DTL. So will you create 20 DTL? No. You will not create 20. You will create the tax rate of 30%. That is 6 rupees. 20 into 30% will give you 6. So this will be DTL. Why I chose DTL? Because the answer was positive. It is that simple. So fair value minus the original value. If tax base is not given, the original value. If the answer is positive, the answer is DTL. If the answer is negative, you will treat DTA. And this DTL will be treated as liability. When I was taking assets taken over minus liabilities taken over. So in that liability taken over, there will also be DTL. If it is obviously DTA, I'll treat it as a part of asset. Right? Okay. Moving ahead. Employee benefit, not very important. That is record as per Ind AS 19 itself. Okay. NCA, important. NCA held for sale. It will be treated as FVLCTS at not fair value, but fair value less cost to sale. Right? Okay. Indemnification asset, again important. How will I treat it? Recorded only if liability is recorded. If I am recording the liability in my balance sheet, that is, if I am taking your liability in my books, at that time, asset will also be recorded. Only if you have promised it. Again, it will not be more than the liability. Reacquired rights, yes, again important. It will be taken at fair value. That means, if I have given you the rights and I'm acquiring that rights only, you will not say it is my rights only, I will take it 900 only. No, you have to take everything at fair value itself. Next, lease, not very important. Contingent asset, not very important. That means you have to pay attention only on 5 points. What are the 5 points? Contingent liability, deferred tax, very important. NCA held for sale, indemnification asset, and reacquired rights. These are the 5 points. Obviously, there are 9 points, but you have to focus only on 5 points while calculating big questions, right? So, if I give you the summary again for PC and for INA, please pay attention. For PC, what to include in PC? There were 6 points, 7 points, but take only 6. Bank. Can I pay through cash? Yes. So whatever I am paying to acquire you becomes PC. If I am paying you in shares, whatever I am paying in shares becomes PC. If I am paying through SBP, the pre-combination period becomes SBP. Okay. If I am paying through previously held investment, so the rule is book profit first and then include in PC. And 2 consideration. First is deferred and second is contingent consideration. For deferred consideration, the answer is present value. Deferred means no conditions are there. No conditions are there. I will pay you, for sure I will pay you. It is deferred consideration. I'll take it at present value. And contingent consideration, it will be considered at fair value on DOA. Today's fair value will be taken, not the future year fair values, right? On contingent consideration, there was another point, that is whether to remeasure it or not. If it is paid through variable number of shares or cash, I will remeasure it every year. That is, every year it will be remeasured, and the answer will be through P&L. But if fixed number of shares are given, it will not be remeasured. Okay. What about deferred consideration? Every year it will be unwinding. That is, interest to provision, each and every year till the last date, right? This is how you will be doing. Okay. What about INA? What about INA? That is identifiable net assets. I will give you 5 points, right? Obviously, I will be taking up all your balance sheet. If this is B limited, I will be taking all your assets, all your liabilities at fair value. This is true. Plus, what I will be taking? I will be taking the contingent liability also. Plus, I will be taking the reacquired rights also. My rights, again, I'm reacquiring it, right? Okay. I'll be considering the indemnification assets also. I'll be taking NCA held for sale at FVL CTS, fair value less cost to sale. Right? These are the 4 points. And the last point is deferred tax. So I feel the important points are contingent liability and deferred tax. Deferred tax, many of the questions will be asked. Sometimes they will give you indemnification, sometimes they will give you reacquired, and sometimes they will give you NCA held for sale. But the important points are contingent liability and deferred tax each and every time. Right? Okay. Now, before moving ahead, I have already explained you what to include in PC and what to include in INA. Is there any query till here? See, minute queries, it will be covered in questions itself, right? But I just want you to focus on what to include and where to include. I've given you a few points. If I'm giving you in payment in cash, through shares, through deferred consideration, through cash, through contingent consideration, through previous investment, through SVP, at that time you have to record in PC. If any of these points are there, it should just click INA, PC, and then I'll be giving you my steps, how to follow the steps. Okay, please tell me, is the point clear till here? Is the point clear till here? Okay, moving ahead. Now, this is a contingent asset, right? I've given you all the points. Now, I'll be taking big questions also, right? A lot of questions I'll be taking so that you don't face any problem. My only aim over here is to make the concepts, recall everything what you have studied in the previous sessions or whenever you have studied for this chapter. My aim is to recall each and every point. Okay. So ABC Limited prepares consolidated financial statements up to 31st March every year. On 1st July 21, ABC acquired 75%. So the date of acquisition becomes 75% of the equity shares of JKL. Okay. And gain control. The issued shares of JKL are 1 crore 20 lakh equity shares. Details of the purchase consideration are as follows. So I'll give you the summary what they have done. My company's name is ABC and the company which I am taking over is JKL. Right? And this has equity of 1.2 crore shares. This information is given. I'm acquiring 75%. And I'm acquiring 75%. Just read the question and start marking. Okay. First of all, I'll give you my steps. What are the steps to follow? Whenever there are huge questions, what are the steps to be followed? The first step is, who is the acquirer? Who is the acquirer? The second step is very important, DOA, that is the date of acquisition. The third step is PC. The fourth step is INA. The fifth step is NCI. And the sixth step is goodwill / GBP. The utmost two important points are 3 and 4. The complete, each and every question depends upon these 2 points. Just stay focused. Everything will be very easy, right? Just start marking of what is the points. Who is the acquirer in this case? Can I say ABC Limited is the acquirer? Okay. Next, what is the date of acquisition? 1721. I guess 21. Yeah, 1721 was the date of acquisition. Since I'm making the first time CFS on 1721, I'll follow Ind AS 103. Every next subsequent years, it will be followed 110. Okay, consolidation for the first time. PC, I have given you 6 points, right? INA, I have given you 9 points, but I'll consider only 5 points. NCI, I have already given you 2 methods, at PSNA or at fair value, whatever the scene has. And goodwill, how to calculate goodwill? It is nothing but PC plus NCI minus INA. If the answer is positive, it is goodwill. If the answer is negative, it will be treated as GBP, right? These are the 6 steps. Just mark, write, just learn these steps and start marking in the question itself. Let's start. First point. On 1st July 21, ABC Limited issued 2 shares for every 3 shares acquired in JKL. On 1st July 21, the market value of investment was 6.5 and the market value of equity of JKL was 6 rupees. See, first of all, I'll be giving you shares, alright? I will not give 100%, but I'll be giving you 75%. Okay, first I'll read the question. Can I say payment in shares is terms of PC? PC step 3. I'll write PC step 3. Next. On 30 June, that is, can I say after 9 months, or sorry, after 1 year, on 30 June 22, ABC will make a cash payment of 71,50,000 to the former shareholders who sold their shares to ABC on 1st July. On 1st July, ABC would have to pay interest at an annual rate. Can I say there is no condition? If there is no condition, is it contingent or is it deferred? That means I have clearly given after 1 year, I'll be paying you cash of 71,50,000. Is there any condition? The answer is no. That means deferred consideration. Again, this is deferred consideration. Is it a part of PC? Yes. Step 3 PC at present value. At present value. Next. On 30 June 23, ABC will make a cash payment of rupees 3 crores to the former shareholders who sold their shares. The payment is contingent upon the revenues of ABC growing by 15% over the period of 2 years. That means they are telling, I will pay you if this happens. That means this is nothing but contingent consideration. This is contingent consideration. Is contingent consideration a part of PC? The answer is yes. Again step 3. Again step 3. But contingent at what value? At present value or fair value? On fair value. On fair value of what? On the date of acquisition. On 1st July, the fair value of contingent consideration was 2 crore 50 lakhs. On 31st March 22, the fair value of the contingent was 2 crore 20. This is irrelevant. I'll have to take this value. That is the fair value on date of acquisition. Okay. On 1st July, the carrying amount of the identifiable net assets in the book value of the company was 6 crores. On 1st July, the fair value of net assets was 7 crores. That means your book value was 6 crores and your fair value becomes 7 crores. Can I say I will take over at 7 crores? The answer is yes. I will take over at 7 crores. Moving ahead, the rate for deferred tax is 20%. They have clearly given deferred tax also. So can I say this is a part of INA step 4? Step 4. Next. During the 9 months ended 31st March 22, JKL had a poorer than expected operating performance. Therefore, it was necessary for ABC to recognize an impairment of the goodwill arising on acquisition of JKL amounting to 10% of its computed value. Now, what is this 10%? I'll explain you afterwards, right? So, this is pending. Impairment is pending. Impairment is pending. Okay, moving ahead. Calculate the impairment of goodwill in the consolidated financial statements of ABC. First of all, I need to calculate what is the amount of goodwill and then I will impair. Under both the methods permitted by Ind AS by computing NCI at the acquisition date. That means they have given both the methods. Now, what are the both methods? NCI at fair value, NCI at PSN, right? Okay. So, let's start with the steps. I have given you 2 steps. Who is the acquirer? ABC. What is the DOA? Date of acquisition 17. What is PC? Can I say I have already marked PC? I have already marked PC. There are 3 PCs, right? First is the number of shares I have given to you. Second is deferred consideration. Third is contingent consideration. So I have to take this. Now, how will I take that? See, first of all, I'll take your shares. 1.2 crore shares are given. So I'll be giving 1.2 crore shares into. How many shares are given? 2 shares for every 3 shares. So into 2 by 3. But I'll not be giving to 100%. I'll be giving only to 75%. Why? I've already explained this 75%, right? Whatever the share I'm purchasing, I'll give those many shares only, 75%. Into, obviously these are my shares. So my fair value will be taken. My fair value will be taken. The market value of an equity of ABC is 6.5. Not your value, but my value. My value is 6.5. So I'll be taking at 6.5. This is PC. First point. Second, deferred consideration. How to take that deferred consideration? I'll be paying 71,50,000 after 1 year. So just I have to discount it. 71,50,000 divided by 1.1. That is 10% for 1 year. Contingent. I have to take this 2 crore 50 lakh directly. So I get my PC. See over here. You can see who is the acquirer, what is the date and PC. PC 3 points. Shares 1 crore 20 lakh shares were there. 75% 2 by 3 at 6.5. My fair value. Second, deferred will be taken at present value and contingent consideration at fair value on DOA. I have taken all these 3. So the PC comes to 7 crore 5 lakhs. The PC comes to 7 crore 5 lakhs. Okay. What is INA? INA. Can I say INA is clearly given 7 crores? Yes. But can I say there is also deferred tax? Yes, there is deferred tax. So how do I calculate? I have already explained you. Carrying amount minus the tax base. What is carrying amount? The fair value 7 crores minus the tax base 6 crores. The answer is 1 crore positive. If the answer is positive, it is DTL, deferred tax liability, into tax rate. What is the tax rate? 20%. So into 20% will give you 20 lakhs, 0.2 crores. This will be DTL. Simple. So it is forming part of fourth step. You can clearly see INA at fair value and DTL 20 lakh rupees negative, right? DTL liability is there and therefore minus 6 crore 80 lakhs. So I have already explained over the here. 4 steps down. What is the fifth step? Fifth step is NCI. How to measure NCI? See, measure NCI at PSNA. It is very simple. Whatever your INA was there, 680, 25% belongs to NCI, 25%. But if it is fair value, please don't forget this. Of the 120 crore shares, 25% belongs to NCI and their fair value was given to be 6 in the top line. And therefore, it is 180, right? And the sixth step is goodwill or GPP. How will I calculate that? PC plus NCA minus PC plus NCA minus INA. This will give you partial goodwill and this will give you full goodwill. Full goodwill, right? And impairment was given as 10%. The goodwill is impaired by 10%. So just impair by 10% and you are done. And you are done. This was asked in your question, right? So this will be asked for 14 marks. Obviously, it is very simple. How did I solve it? I just started marking the points. Where to include in step number 3 or 4. Let's repeat the steps. What is step number 1? Acquire. Second, DOA. Very easy, right? Who is the acquirer and what is DOA? Third step, PC. What to include in PC? I've already showed you. Second step, fourth step, INA. Fifth step, NCI. And sixth step, goodwill or GPP. How to calculate goodwill? PC plus NCI minus INA, right? This is how I calculate. I hope the point is clear and it's very simple. Okay. The next point. Question number 55. Bima Limited acquired 65% of shares on 1st June of NAFA Limited, which is engaged in the production of components of machinery. Okay, 65% on 1st June. Who is the acquirer? Bima Limited is the acquirer. So step number 1 is done. DOA. Step number 2 is done. Moving ahead. NAFA Limited has 1 lakh equity shares of 10. Of the company which I am purchasing, that company has 1 lakh equity shares in their balance sheet. The quoted market price is 12. Their market price is 12. Okay. The fair value of NAFA Limited's identified net assets is 80 lakh rupees. That means your value is coming to be 80 lakhs. It is clearly given. That means step number 4 is clearly given. INA. Moving ahead. Bima Limited wired rupees 50 lakh in cash and issued 50,000 equity shares as purchase consideration on the date of acquisition. Can I say this is PC? Whatever cash I'm paying, whatever shares I'm paying, it is PC, right? Okay. The quoted market price is 25. Obviously, whatever the shares are I'm giving you, it will be termed as PC. Bima Limited also agrees to pay additional consideration of 15 lakh if. The answer is if. That means it is contingent or deferred? Contingent. It is based on conditions. If this happens, then only I will pay you. Okay. So this is contingent at what value? Present value or fair value? The answer is fair value on DOA. Earned by NAFA exceeds 1 crore over the next 3 years. On the date of acquisition, NAFA Limited assessed and determined that it is considered probable that an extra consideration will be paid. It hardly matters whether probable or not. The fair value of this consideration on the date of acquisition is 980. This is important for me. So can I say this is again PC, contingent consideration. NAFA Limited incurred 1,50,000 in relation to the acquisition. It measures NCI at fair value. They have clearly given NCI at fair value. Moving ahead. How will the acquisition of NAFA Limited be accounted for and prepare a detailed working and pass the journal entry? Okay. So if I tell you two steps we are down. Third step is PC. Can I say PC? They are given two points. Cash is given 50 lakh rupees. Shares is given of 50,000 equity and add rupees 25. So 50,000 into 25 and 50 lakh is the cash. Both are PC. And next is 980 will also be considered as PC. Assets they have already given. So what are the steps? Just follow though. Acquirer Bima Limited. DOA 1st June. PC. Cash I am paying. I am giving you shares and contingent consideration on the date of fair value on the date of acquisition. 70 to 30. INA ready-made given. Third and fourth point are given to you, right? PC INA. Fifth step. What is fifth step? NCI. How will I measure NCI? Please don't forget. It is given as fair value. And is your fair value given? The answer is yes. 12 rupees share. Your company share is trading at 12 rupees, right? How many shares were you having? 1 lakh shares. In your balance sheet, you were having equity shares of 1 lakh. Can I say 65% belongs to me, but 35% belongs to NCI? 35% means 35,000 and your fair value is 12. 35 into 12 will give you the NCI, 4,20,000. and goodwill is calculated as PC plus NCA minus INA. If the answer is positive, it is goodwill. If the answer is negative, it is GBP. You cannot write capital reserve. So by mistake, I wrote capital reserve. It is GBP, right? Okay. And the journal, very simple. INA to bank. INA to bank, the first entry, right? Did I pay you shares? Yes, to equity share capital. But if you remember, equity share capital together it comes with premium, right? Why premium? Because 10 rupees was the face value and 15 was the premium. Next, am I paying you provision? Yes, provision for contingent consideration, right? 9 lakh 80 to NCI already measured, and whatever the difference is becomes GPP or the goodwill, and the balancing figure is GBP, right? This is the point. Again, very simple. Okay. One of the important question, very nice question it is. The balance sheet of Professional Limited and Dynamic Limited as at 31st March 22 is given below. Now, first time they have given the balance sheet, first time. How will I calculate it? In these type of questions, step number 4 is very important, that is INA. How to calculate it? The balance sheets of 2 are given. I will not read the balance sheet first. I will read this thing. Professional Limited acquired 70% of Dynamic on 1st April. See, this is the balance sheet of 31st March. On this date, I am acquiring. How much am I acquiring? I am acquiring 70%. That means I will say I'll acquire all your assets. All the assets will be acquired. I'll acquire all the liabilities, but won't acquire this. I will not take your equity and other equity, right? I'll be acquiring your assets and I'll be acquiring your liabilities at which value? At fair value. If the fair value is not given, I'll copy paste the values. If given, then I'll give the answer. Okay. Let's assume no fair value is given. So how will you calculate? It is very simple. All the assets is 1380 minus all the liabilities, whatever the answer is. Let's say it's 675. Whatever the answer is, assets minus liabilities will give you INA. Simple as that. Assets taken over minus liabilities taken over at fair value will give you the answer. This is step number 4, INA, right? Okay. Moving ahead. What are they telling? See, the question is big, so please pay attention. By issuing own shares in the ratio of 1 share of professional for every 2 shares. That means shares are giving PC. PC, step number 3. The fair value of the shares is 40 rupees. Okay, 10 rupees is capital, 30 rupees is premium. The fair value resulted in the following. Fair value of PPE was 350. That means the fair value is given. So I'll write over there fair value. The fair value is 350. Okay. Next. Professional Limited agreed to pay an additional payment as consideration that is higher of 35 lakhs and 25% of any excess profit in the first year after acquisition over its profit in the preceding 12 months made by Dynamic. This amount will be due after 2 years. Dynamic has earned profit of so and so. Now the problem over here is, see, so many students say that sir, this is nothing but contingent, but I will say it is not contingent. Why not contingent? It is deferred. Why? See, anyhow I am paying you higher of 35 or something. So 35 obviously I have to pay you. If your profit comes higher, then I will pay you more. That means it is not that I will not pay you. 35 is for sure. That means it is not contingent, it is deferred consideration. It is deferred consideration. Again, a part of PC. See, over here, sometimes the students feel that, so it is higher of 35 or something. That means it is contingent. Contingent is, I will not pay you. If this happens, then only I will pay you. Over here, I will pay you for sure. I will pay you either 35 minimum or else I will pay you more than that. Therefore, you have to consider this as deferred, right? So obviously, this deferred will be considered at present value, not the fair value. Okay, after 2 years is given, just start marking over. So PC, 2 points are PC. This is INA because fair value is given. Okay, next. In addition to the above, Professional Limited also agreed to pay one of the founder shareholders payment of 20 lakhs provided he stays with the company for 2 years. This is not a part of PC, not a part of INA. What is happening is, let's say you are the manager in B Limited. You are the manager in B Limited. I told you, come in my company, stay with my company, I will pay you 20 lakh rupees. Can I say it is because of the work you will be paying? That means, can I say it is nothing but as good as salary? You are not giving it for free, right? He will come, he will work and then I'll pay you. It is salary. Whenever you will pay, transfer it to PN. It is not a part of PC. Next. Dynamic had certain equity settled share-based payment. Equity, remember SBP? Yes. So again, SBP is a part of PC. These are the only shortcuts which you have to follow. These are the only shortcuts which you have to follow. Dynamic Limited had a certain equity share-based payment Original reward which was replaced by the new rewards issued by Professional Limited. The answer is replaced, right? So what was the answer? Original, what was the reward? Original reward into expired period divided by the number of years, right? So it will be pre-combination period. Okay. So as per the original terms, the vesting period was 4 years. And as the acquisition date, Dynamic has already served 2 years. That means out of 4, 2 is already passed. Or 2 is already passed. Okay. As per the replaced rewards, the vesting period has been reduced to 1 year after the acquisition date. That means now the acquisition will be only 3 years. Sorry, the duration will only be 3 years. Okay. The fair value of the award was as follows. Original was 5 and the replaced was 8. What I have to take is 5 lakhs into the expired period upon the original period or the revised period, whichever is higher. So the answer is 4 years. So this is treated as the pre-combination and this is treated as part of PC. So what is the part of PC? 2.5. 2.5. Now, what is the replaced one? 8. So I have to pay total of 8, out of which 2.5 comes to pre. So the balance amount of 5.5 comes to post, which will be transferred to P&L by the holding company throughout the remaining life, and the life is only 1 year, right? So next year it will book to 5.5 to P&L. Next. So this is again PC. Dynamic had a lawsuit pending with a customer who had made a claim of 50 lakhs. Management reliably estimate the fair value of the liability as 5 lakhs. Can I say this 5 lakh is a contingent liability which also will be taken? That is a part of INA. If you remember, contingent liability are part of INA. Contingent liability, NCA held for sale, reacquired rights, deferred tax are a part of INA, right? The applicable tax rate for both the entities is 30%. They have clearly given that you have the tax rate. That means again INA part because DTA or DTL will come. You are required to prepare the opening consolidated balance sheet. Now, what you have to do? Just be careful while the steps. Let's repeat the steps. What was step 1? Step 1. Step 1 was acquirer. Who is the acquirer? Can I say the acquirer is professional? See, I have the solution, but I'm still writing with you. Why? Because sometimes you might miss a point while reading out. Therefore, I'm writing it with you. Okay. Step number 2. Step number 2 is DOA. What was the date of acquisition? What was the date of acquisition? So can I say the date of acquisition was 1st April? See, why I'm writing DOA? Because it may happen that you would feel that this is a question of 103, but the question might be of 110, right? So this is very important and you have to write DOA. It is 1422. Okay. What is step number 3? Step number 3 is PC. So I'll just check my markings. What are included in PC? So over here it is shares. Shares. Second, contingent. Third, SBP. Sorry, deferred SBP. Only 3 points are there, right? So what are the number of shares I'm giving to you? I'm giving you 1 share for every 2 shares. So first of all, I'll check how many shares are there in your balance sheet. Check how many shares. So I'll be looking at the balance sheet of Dynamic 400 and the value of equity share of Dynamic is 100 rupees. That means can I say 4 crore shares are there? 4 crore lakhs, sorry. 4 lakh shares are there. Obviously, this 4 lakh shares, I will be giving 1 share for every 2 shares. There is a 1/2. I will not be giving to entire person and I will be giving only to 70% and my fair value comes to 40. So, if you check in the PC point, 4 lakh shares were there. I have already calculated 4 lakh shares. Into 70% to 1/2 at 40 rupees, 56. I have given the bifurcation. Capital will have only 10 rupees and premium will have the 30 rupees, right? So, this I have already given you bifurcation. Okay. Was there any deferred consideration? The answer is yes. I've taken 35. Why 35? I'll explain you further, right? 35, I have to pay after 2 years, and the rate of discounting is given over here. 10% discount rate. 10% discount rate, right? So you just have to take the 10% discount rate for 2 years. It comes to 28.93. And there was also SBPR. I've already explained you 2.5, right? SBPR, pre-combination period. 5 lakhs into 2 years have already expired and divided by the total term was 4 years. This is the pre-combination and remaining was post-combination. So this is PC. Now what is INA? What is INA? See, I'll be taking your entire balance sheet. All the assets, all the liabilities I'll be taking over. Only one fair value is given, which is the PPE. Only one fair value. Apart from these, obviously I'll be taking like this. PPE 350, then this 100 as it is, then this 150 as it is, this 300 as it is, this 100 as it is, this 230 as it is. All the liabilities I'll be taking over at book value itself. Everything I'll be taking at fair value. If you don't give me the fair value, book value itself becomes the fair value. Apart from this, this I have to get 350 because at fair value. After that, there are 2 points of INA. I've already marked. What are the 2 points? First is a contingent liability. I'll be taking at 5 lakhs. That means one more liability is there of 5 lakh rupees. Also, there is DTA or DTL. How will I create DTA, DTL? There should be a difference. So there are two differences. First is the PPE. First is the PPE. This one, there's a difference, right? My value and your value is not matching. This one. And second, you don't have any liability of contingent, but I have a liability of 5 lakhs. And therefore, if in your books there is no liability, if in my books there is 5 lakh, there's a difference, right? So there are 2 points on which DTA or DTL will be created. First is any fair value which is given, and the second is any contingent liability which is not in your balance sheet, but I am taking at the balance sheet, right? So I'll be taking over that. So while calculating INA, if you can closely watch, I have just copy pasted entire dynamic. Whatever the balance sheet I'm acquiring, I'm taking right now. So 1, 2, 3, 4, 5. I have copy pasted C. 100, 150, 300, 100, 230. I'll see over there. 100, 150, 300, 100, 230. Everything. This 500, the value was given as 350. So I've taken 350 over here. If you can closely watch. This 350. On to the liabilities. Let's say what are the liabilities. The liabilities are 200, 70, 35, 150, 300. 200, 70, 35, 150, 300. 200, 70, 35, 150, 300. Everything is given, right? So what is left? So the first point is I have taken this at 350, first point. Second point, I also have to take the contingent liability of 5 lakh rupees. Contingent liability, right? Because there was a lawsuit pending. So I've taken the contingent liability at 5 lakh at fair value. So this is done. And now comes the question, what is DTA or DTL? So I've already explained you. For asset, I'll be taking carrying asset minus tax base. For liability, I'll be taking tax base minus carrying amount. These are the 2 points, right? So let's analyze the over here. For PP, what was my carrying amount right now? 350. I'm taking at 350. But what was your original tax base? Original value 500. So can I say I'm getting the answer negative? I told you if the answer is negative, it is DTA. Positive DTL. So the answer is 45 DTA. Okay. On to the liability. I already told you. First take the tax base. Can I say tax base means in your balance sheet it was 0 and now I'm taking at 5. My carrying amount is 5. So the answer is again negative, again DTA 1.5. So the total DTA comes to 46.5. 46.5. Over here I have written DTA 46.5. And now all assets minus the liabilities will be INA. That is identifiable net assets. So I got point number 4. What are the steps? First, acquire DOA. Third step very important. Fourth step very important. 3 and 4 are very important. 3 and 4. Obviously, it is not a one-day procedure. It needs a bit of practice. Where to include that? So I've given a summary and the summary and the summary again and again. What to include in what? PC or INA. These are only the 2 points which you have to check, right? So, and now, what was the answer for deferred consideration? It was higher of 35 lakhs or 25% of excess profit. Previous 12 months it was given as 10 lakhs. Next 12 months it was given as 30 lakhs. So what was the excess profit first and next year? It was 20 lakhs. So I'll be giving 25% of 20 lakhs, which is only 5 lakhs. So what is the higher amount, 5 lakhs or 35? The answer is 35. See, what they have told is, previously you were earning 10 lakh rupees. So what are the terms? Either they will pay 35 or they are telling that any profit above 10 lakhs, they will give you any excess, 25% on that excess. So I have checked the next 12 months profit. The profit reached to 30 lakh rupees. So the excess was 20. 20 of 25% will give you 5 lakh rupees. So 35 or 5, the answer is 35. So therefore, deferred consideration is 35. This is how I have taken. Now, how will I make a balance sheet now? See, it is very, very, very simple. Just pay attention. Copy paste your balance sheet as it is. As it is means as it is. Copy paste the INA as it is. That is PP 300 mine and 350 there. 400 mine and 100 there. And just add up everything. Right? So I've done over here. If you can closely watch in the balance sheet. Obviously, this is not the format of the balance sheet. You already know the balance sheet assets and then liabilities, right? But I've explained in T format. It is very simple. In exams also, you can make a T in rough and then make it fair. So, this first amounts are my amounts, copy pasted amounts, copy pasted. And these are the new amounts which I have taken. Obviously, I'll take over at fair value. Okay. NCI already given to you. Long-term borrowing. All right. Next. Long-term provisions, you have to take 28.93 as the deferred consideration also. Because it was a provision. Whatever I paid, I have paid through shares, through deferred consideration also, right? And through SBP. If you can closely check, the SBP also comes over here. There was a one contingent liability. There was contingent liability, right? DTA 46.5 was DTA. So I have subtracted and written the answer 28.5. short-term borrowings, trade payables, just copy pasted the amounts, everything. What you have to be very sure of is these two amounts. 2.5 SBPR, 42 was the premium and 14 was the equity which I issued, which was nothing but these amounts are PC, right? You just have to give impact of PC 1, 2 and 3. All these amounts were PC. If you remember, 14 plus 42, 56 was shares, 2.5 was SBPR and 28.93 was deferred consideration. So you just have to make the proper places of these one. So you just have to include three things: PC, NCI and goodwill or capital reserve. Over here, there was the goodwill was, the capital reserve was 274.14. So I've written over here capital reserve. So step number 345 becomes important. How does it become important? Because I'm just adding up the values and that's it. We are done with that, right? I hope the point is clear till here. So this was one of the very important question. And next point, what is measurement period? Measurement period means See, it may happen that I'm taking you over, I'm taking your business, let's say 80%, and you're not able to, get a clear information of the INA. What is the fair value? You're not able to get that. So will I postpone my recording? The answer is no. You will have to record right now. For example, I say, if this is B Limited, and I'm acquiring 80% of the share capital. So obviously I need to calculate all the assets, all the liabilities at the fair value. But the problem is I'm not able to get the clear information of the fair value right now. So will I postpone the recording? No, first give me the fair value, then only I'll record. No, the answer is no. What you have to do is, you have to make a provisional INA. Provisional INA. What is provisional INA? Assume value by yourself only. एक अंदाजा आ जाता है ना, take an approximate value, whatever you like. Obviously, plus or minus, moreover, plus or minus something, plus or minus 100, 200, 300 crores, right? Okay. So you just have to take the INA at that time. Now, what do you mean by measurement period? See, the point is very simple. If from the DOA till 1 year, from DOA till 1 year, if you get any further clarification of the INA and of the conditions which were associated on DOA, at that time, you can adjust the INA through goodwill. For example, let's say you took, okay, I've already written the example over here. See, A Limited acquired 75% of B Limited on 1/4/22 for rupees 800 crores. So I've acquired 75% for 800 crores rupees. That means I have paid 800. INA of B Limited not available on the DOA. I'm not getting any DOA at that time. So I took, okay, your value will be 1000 crores. Let's assume 1000 crores, right? NCI is measured at PSNA. So how will I measure the answer? So the answer is very simple. It is INA to bank. INA is 1000 to NCI. How much is the NCI? It is 1000 into 25%, which is 250. Bank I am paying 800, and whatever the differences becomes goodwill. So the goodwill comes out to 50. Very simple. Okay. Now the problem is, obviously I don't have the INA right now, so I took 1000. But it may happen that it may be, the value may be plus or something minus also. So till 1 year, that is known as the measurement period. Till 1 year, you have time to get the information collected. Till 1 year. So on 1st March, that is after 11 months, within 1 year, right? Actual value of INA on date of acquisition was 1030. You came to know finally the values, that is 1030. So can I say you have to increase the assets? Yes. If you have to increase the assets, you can adjust by goodwill. But can I say NCI was measured on INA, but PSNA matlab INA, right? At PSNA. So can I say the proportionate sale NCI will also bear? NCI will also get the value, right? Because NCI was measured on PSNA. And therefore, if I'm changing INA, NCI will also change. So 75% will be adjusted through goodwill and 25% will be adjusted through NCI. But if NCI was measured at fair value, if in the previous point NCI was measured at fair value, then the entire value will be borne by goodwill and not NCI, because NCI was already measured at fair value, right? That means if within 1 year you get the correct information, you can adjust through goodwill. If NCI is measured at PSNA, then NCI will also get the share because it is completely based on INA. If not, then the entire value will be goodwill. Now we given a summary. Please have a look at this summary. If information is received 1 year and that relates to DOA, then adjust through NCI, adjust through goodwill and NCI if at PSNM. If the information is received within 1 year but does not relate to DOA, that means you're getting the information within 8 or 9 months, but you're getting the information of that day, not of DOA, then at that time you have to adjust, but through P&L, not through goodwill. Okay. And if the information you're getting after 1 year, at that time also adjust through P&L, not through goodwill. That means the points are, if you're getting the information within 1 year, if you're getting the information within 1 year, at that time, if you're getting the information within 1 year and it relates to the date of acquisition, only at that time you can adjust through goodwill or not. So whether to adjust through goodwill and NCI or only goodwill, so it depends upon if NCI is measured at PSNA, at that time goodwill and NCI both, because NCI will also change through INA. But if NCI is measured at fair value, at that time only goodwill will be borne, right? So this is the point of measurement period. This is the point of measurement period. Next. So if you check this question is of 3 full pages. That means in your examination it can come to 4-5 pages also, right? I'll also take this question. One of the important question covers each and every point, okay? So please pay attention. I'll be taking this question. Obviously in the examination, such a big question won't be asked. So what will be asked? What they will ask? They will remove 1 or 2 adjustments from this. This is the only point they can ask. The concept will be the same. They will just remove. So how will I answer this? It is very simple. What I'll be doing is I'll just start marking whether it is PC or INA, that is. Only this point you have to mark. Let's start with the question. H Limited acquired equity shares of S Limited, a listed company, in 2 tranches. Okay, before starting, just give me a 1 minute break. Okay, let's continue. H Limited acquired equity shares of S Limited, a listed company, in 2 tranches as mentioned in the below table. So on 1st November 26, 15%, and on 1st January 27 at 45%. Can I say this is step acquisition? This is step acquisition. So remember, step acquisition, it is a part of PC. So what was the hint on step acquisition? First book profit and then including PC. First book profit. So can I say I actually acquired you on 1st Jan? So who is the acquirer? Who is the acquirer? H Limited. And what is DOA? It is 1/1/27. 1st January 27 is DOA. That means on this date I became holding, right? Okay. Both the above mentioned dates, companies have rupees as their functional currency. Consequently, H Limited acquired S Limited on 1st January 27. Following is the balance sheet. Okay. Now, if you can check, the following is the balance sheet of S Limited. That means balance sheet won't be asked. Why? Because only the balance sheet of S is given. Carrying amount and the fair value is given. Carrying amount and the fair value is given. Okay. Just I'm reading out what is there in the balance sheet. PP, intangible assets, investments, inventory, trade receivables, cash held in foreign currency, NCA held for sale. NCA held for sale. Remember INA part, NCA held for sale at fair value less cost to sale. Okay. Equity I won't be taking. Other equity I won't be taking. Next, financial, trade payables, provision, current assets. I will be taking everything. That means, can I say INA is nothing but all assets minus all liabilities at which value? At fair value. At fair value, right? This is the point. So this will be INA. This will be for sure INA. But the important point is, on this part, I cannot take 4.5 because it is fair value. I cannot take 4.5. I have to take fair value less cost to sale, right? So only this point, it is NCA HFS. What is HFS? Held for sale, right? Okay, moving ahead. So this is part of INA. So entire INA is given. I just have to take copy paste the fair values and I have to calculate the INA. Okay. And the date of acquisition was 1st January. Okay. Over here, other information. Following is the statement of contingent liabilities of S Limited on 1st January 27. Contingent liabilities of S. That means, can I say I'll be taking over this also? Okay. Lawsuit filed by the customer for a claim of 2 crores, the fair value is 0.5. Obviously, this is 0.5. I'll be taking contingent liability. Can I say contingent liability forms part of INA? Yes. Moving ahead. Income tax demand of 7 crores raised by tax authorities. S Limited has challenged the court. Okay. And the fair value is 2 crores. Obviously, this is again a contingent liability. So, this will form part of INA again. Contingent liability, right? Okay. Moving ahead. In relation to the above mentioned contingent liabilities, S Limited has given an indemnification undertaking to H Limited up to maximum 1 crore. That means they are telling if possible, if you pay any of these amounts, I'll be giving you 1 crore. Remember, if I'm taking the liability, I can also take the asset, right? So this is indemnification asset, a part of INA. Just keep on marking so that it becomes simple for you, and then just follow the 6 steps. Okay. Rupees 1 crore represents the acquisition date fair value on the indemnification asset. Okay, this 1 crore is nothing but on the date of acquisition. Okay. Any amount which would be received in respect of undertaking shall not be taxable. That means they are telling don't calculate DTA or DTL on this 1 crore rupees. Okay. The tax basis of the assets and liabilities is equal to the respective carrying amounts being recognized in the balance sheet. Obviously, if it is not given, then also we calculate the tax base as the carrying amount itself. Carrying value of the, see, this is of no use, this is of no use. Carrying amount of non-current asset held for sale for 4 crore represents fair value less cost to sale. This is important. See, over in the balance sheet, it was given NCA held for sale, and it says the carrying amount represents the fair value less cost to sale. The carrying amount is 4 crores. Over there, it is carrying amount, right? So I will say 4 crore is FVLCTS. I'll take this 4 crore, not 4.5, right? So many times we take all the fair values. So please be sure NC held for sale will be taken at FVLCTS. Okay, moving ahead. So this is part of INA. I'm just marking it, right? Okay. In consideration of the additional stake purchased by H Limited, it has issued selling shares 1 equity share for every 2 held. Fair value of equity shares of H is 10,000 per share, 10,000 rupees. Okay. So this is, can I say PC number of shares? On 1st January 27, H Limited has paid 50 crore in cash to the selling shareholders S Limited. Again, shares mein de rahe to PC. Additionally, on 31st March 29, can I say after some period, H Limited will pay 30 crores to the shareholders if, the word is if. Again PC. But when they say if, it is contingent consideration. And when I say contingent, it will be taken at fair value on date of acquisition. Okay. For the year 31st is more than 25%. H Limited has estimated the fair value on the obligation on 1st Jan 27 and 31st March as 22 and 23. So can I say I will take 22 fair value on date of acquisition. On 31st March, that is the end of the year, I will not be taking that. Moving ahead. The change in fair value is attributable to changes in facts after the acquisition date. Okay. Quoted price. Why are they giving quoted price? Because of the step acquisition, if you remember. That is PC. So, on what rate you will transfer on the date of acquisition, right? Quoted price of equity shares on various dates are follows. On 31st March 26, on 1st Jan. So, my value will be taken on 1st January 395 rupees, right? Okay, moving ahead. On 31st May 27, H Limited learned that certain customer relationships existing on 1st January 27, which met the recognition criteria of an intangible asset as on that date, were not recognized during the accounting of business combination for the year 31st March 27. The fair value of such customer relationship is 3.5, assuming there are no temporary differences. Consequently, there is no impact of income taxes. That means they are telling not to calculate DTA, DTL, but can I say, if in your balance sheet there is no customer relationship, but if I am acquiring, I can take it as an asset, right? So this is intangible asset INA. On 31st March itself, H Limited learned that due to additional customer relationship being developed during the 1st Jan to 31st March, the fair value of such customer relation increased to 4 crore. See, after my acquisition, if the value is increasing, that is because of me, and that will be self-generated. So this won't be taken. I can only take on the date of acquisition, not after the date. So the value has increased after the acquisition, right? So after acquisition, it is because of me. It is not because of you. So it will become the self-generated, and self-generated cannot be recorded. Next. On 31st December, H Limited had established that it has obtained all the information necessary for accounting of the business combination and that more information is not obtainable. H Limited and S Limited are not related parties and follow Ind AS. Income tax rate is 30%. Again, DTA, DTL. DTA, DTL form part of INA. That is again INA. I'll just mark over here. Marking is very important. Okay, moving ahead. You are required to prepare the following in response and give the computations. What will be the goodwill or bargain purchase to be recognized by H in its financial statements for the year ending 31st March 27? For this purpose, measure NCI using proportionate share of the fair value of the identifiable. That means at PSNA, proportionate share. That means PSNA. I'll read the B and the second and the third point later. So first of all, I'll go by my steps. What are my steps? Please check. What are my steps? The steps are very easy. The steps are first point, acquirer H Limited, DOA 1127 on the date when I established control on you, right? So 60% was my holding. Okay. The third step is PC. What are PC over here? So I can just mark. Step acquisition is first point. Next, I'm giving you shares, I'm giving you cash, and there is a contingent consideration. Can I say there are 4 PCs? 4 PC, and also, okay, 4 PC and step acquisition. So basically, I'm giving you shares, I'm giving you cash, I'm giving you previous year investment, and I'm also giving you contingent consideration. 4 points of PC are there. Okay. First, I will calculate the previous investment. So what was your previous investment? It was 15%. How many shares are there? Obviously, I've invested in your company. Your company has how many shares? Please check. It is 12, face value 100 rupees in crores. So can I say 12 divided by 100 will give me 0.12 crore shares? Into 100 will give me 12. So you are having 0.12 crore shares, of which 15% I hold right now. 15%. Right? Initially 15% were there. So how many shares were there? 0.12 into 15%. I will value this at what rate? At 395. I'll add 395. This is my PC, right? Okay. So over here, I will show you. 0.12 crore, 15% at 395. This is first point. Okay. The second point. Second point is, I will give you 1 share for every 2 shares held. Obviously, I'll be giving only 45%, not to 60%. 15% was separate. Now I am purchasing only 45%. I will give you only 45% shares, right? So 1 for every 2. How many shares were you having? 0.12, right? Into 1 divided by 2. Only for 45% stake, and my value is 10,000. So over here, if you can check 0.12, this is important. The students make mistake over here. They will take 60%. Why 60%? I have only purchased 45% right now. 15% I already purchased 2 years back. 45% is now what I am purchasing, right? Into 1 by 2 into 10,000. So the answer will be 270 crores. This is the point. Okay. Next. Also there is one more PC. 50 crore in cash. I'll be paying you 50 crore in cash. So I'll be taking cash of 50 crores. And there is also deferred consideration. Deferred consideration. How is deferred consideration made? As present value or fair value? The answer is fair value on date of acquisition. That is 22 crores. So I'll be taking this 22 crores over here. This will give me the amount of PC. Now, how will I calculate INA? The third part, INA. See, 3 steps are down. Acquirer, we are done. DOA, we are done. PC, we are done. How was it easy to calculate the PC? Because I've read the question and I've started marking on it, right? So it was PC. Moving ahead. Now, what is INA? Obviously, I'll be taking this entire balance sheet at fair value. 1, 2, 3, 4, 5, 6. But this I'll be taking at fair value less cost to sale, which is 4. They have clearly given. Okay. And I'll be taking all the liabilities this points. So if you can check over here, I've done 1, 2, 3, 4, 5, 6, and 7 over here 4, and 1, 2, 3, 4. 4 liabilities were there, right? And now, what are the extra parts given in the additional information? In the additional information, see over here, INA. What is this? 0.5 and 2. This is contingent liability. This is contingent liability. So I'll be writing contingent liability as in the part of liability. Over here, contingent liability. 1 INA down. Next, they have given 1 crore as indemnifying asset. Can I say this also form part of INA asset? So add in assets, indemnification asset. And now the next part, whether INA is marked. So I'm done with this 4 crores also. I'm done with this 5 and this INA done. What is next INA? Next INA. Customer relationships. I haven't taken this. Yeah. Intangible assets. Over here. Just 1 minute. Okay, this was measurement period. I'll be, consider this point after 1 minute. Okay, first I'll calculate the answer. Next, moving ahead. Next was DTA, DTL. So how to calculate that? It is very simple. I have printed over here. See, 3 points were there: PP, intangible, and investments. Others are on book value itself. So carrying amount minus tax base. What are the carrying amounts? The fair value. The fair value. And what are the tax bases? The answer given in the carrying amount. Carrying amount. Okay. Old carrying amount. In the balance sheet, it was given to you. So if the answer is positive, it is DTL. So answer is DTL, DTL, DTL. Also, there was a contingent liability of 0.5. Just 1 minute, by 0.5. Yeah, over here it is clearly given. Any amount which would be paid in respect of loss will be tax deductible. That means over here we have to create DTA or DTL. And over here it is not given. This sentence is not given. Therefore, no DTA or DTL. And moreover, they have clearly given an amount will be paid for this one, right? So there is no tax implication. So I'm not creating any DTA, DTL over there. I'm just creating DTA on all 0.5. So over here you can see 0.5 DTL. Yeah, over here 0.5 DTL. So the answer is again DTA. Now please clearly see 15 plus 3 plus 75 and minus 0.15 because it is DTA. All the above were DTL. So 92.85 becomes DTL. So I've included in the net DTL list. Net DTL list. Right. So we are done with assets. We are done with liabilities. Assets minus liabilities will give me INA finally. Right. So see, it was a lengthy question, but not tough question. You can copy paste these points from the balance sheet itself at fair value. It was clearly given to you. All the liabilities easily given to you. This contingent liability was given in the table. Indemnification asset was given in just below that. You just have to focus on DTL. How to calculate DTA? I'll already explained you. Carrying amount minus tax base, what is the amount into tax rate, right? So this is INA. How was NCI measured at PSNA? So this amount at 40% because 15 and 45 I acquired 60%, 40% is your share. I'll calculate goodwill. This is the final answer. Now, what was measurement period? Measurement period. See, over here, I just forgot to take the date, and that's why I wrote INA mistakenly. Just pay attention. On 31st May 27, this was a point of measurement period. I'm so sorry, I just did not read the date over there. What was the date of acquisition? 1/1/27. Can I say I have the measurement window till 31st December 27, 1 year? Measurement window, right? This is important point. What the important point? On 31st May, that is just 5 months after, H Limited learned that certain customer relationship existing on 1st January, that is some relations which were existing on the 1st January that relates to DOA, right? Those will be recorded again. That is INA 2. Can I say it will be adjusted through goodwill? And if NCI was measured at PSNA, some share will be borne by NCI also. This was the second point asked. If you can see the question, what amount of NCI, goodwill or bargain purchase so recognized in A should subsequent as on 31st March 27? If yes, provide relevant journal entries. So you just have to provide these also. That means the measurement window. So I have given the entire explanation over there. As per Ind AS 103, if within 1 year we get the exact fair value which relates to DOA, then the such change should be recorded and adjusted through goodwill. So I'm recording the intangible asset 3.5. 40% will be borne by NCI and 60% will be borne by goodwill. Customer relationships generated from 1st January to 31st May does not relate to DOA. Moreover, it is a self-generated and should not be recorded. This I have already explained you, right? This I have already explained you. Only this point I missed the date and that's why I wrongly recorded it as INA, but it was actually measurement window, right? Next, and next point what they have asked. Next point what they have asked. What should be the accounting treatment of contingent consideration as on 31st March 27? Remember contingent consideration on day one, I record at fair value on DOA. And at every year end, I remeasure it. Remeasure through P&L. That is if the value increases or decreases. Even if the shares are fixed, I will not remeasure. But over here, I am paying the consideration as cash, right? 30 crore will be paid. So if it is cash or variable number of shares, it will be remeasured. So what is the value on 31st March? 23 crores. Can I say the value got increased by 1 crore? So you have to pass the journal entry of 1 crore, and that is nothing but P&L to provision, 1 crore entry. It will be adjusted through P&L. I have also given some of the information. If it is a part of PC, and it should be included in PC at fair value on DOA. If the consideration is in cash or variable number of shares, then it will be remeasured every year. If the consideration is given in fixed number of shares, then remeasurement is not required, right? So this is the answer, and we are done with the entire question. So I hope you got this point. This was one of the huge question, a big question, right? Okay. As I told you, I have already taken the example, the concept question initially of the consideration, right? Contingent. So this is the question. Just pay attention on this. How much contingent consideration payable in relation to a business combination be accounted for on initial recognition and at the subsequent measurement? So they are asking for contingent consideration. So the rules are very simple. If it is a contingent consideration, day one always at fair value on DOA. Future years, you will either remeasure or not, depends upon if it is in cash or variable or if it is fixed. If it is cash or variable, you will remeasure it. If it is fixed, you will not remeasure it. Okay. So on 1st April 21, A Limited acquires 100%. It is acquiring 100% of B Limited. That is 100% share is with me, no NCI. As per the terms, the purchase consideration is paid in 2 tranches. An immediate issuance of 10 lakh shares of A Limited having face value of 10. Okay, I will be giving you 10 into 10, that is 100. And a further issuance of 2 lakh shares after 1 year if the profit becomes, if the answer is if, that means it is contingent. If the profit is for 1 crore, after following 1 crore, right? Okay. I will give you 2 lakh shares more. The fair value of the shares on the date of acquisition is 20. That means this 10 lakh shares will be calculated at 20 rupees. Further, the management has estimated that on the date of acquisition, the fair value of the contingent consideration is 25. They have clearly given. The fair value on the DOA is 25. So you have to take that 25. So what is PC? The amount of shares you are giving. So what are the number of shares you are giving? 10 lakh shares into aaj ka price is 20, 200 plus the contingent consideration, that is fair value on DOA, 25. That means the total PC is 225. 225, right? Okay, moving ahead. What they are telling. Continuing the above, now I'll just explain in short what they are telling. What will you do of this 225? If it is fixed, the value comes to 240. The value comes to 240. Now, will you remeasure it? If it is fixed, the answer is no remeasurement required. Even if it is 240, I will not measure because it is fixed number of shares. Okay. Will your answer differ if it was variable? The answer is yes. I would have remeasured it at 240 by making a journal entry of P&L to provision of 15. That is, I'll bring the provision to 240. This is the answer. So these are the 2 points they have asked. I have given the explanation over there. 225. At the end of the year, the contingent consideration won't be remeasured since the fixed number of shares are to be given. First point. Second point. I have not given. I'll explain you this black portion later. Okay. Purchase consideration 225. And at the end of the year on 31st March, the contingent consideration will be remeasured since variable number of shares are given. So the answer will be 15. I've already explained you. Now, what was that? See, over here, 25 was contingent, right? I will not remeasure anywhere. It will be 25 and 25 and 25. Okay. Contingent because if you achieve this thing, I will give you. If you don't achieve, I will not give you, right? So, if the target was met, can I say I have to pay you number of shares? I have to pay you number of shares, right? So, the provision for contingent consideration was 25 and 2 lakh shares I will pay you, and whatever the extra amount is premium. If I'll pay you, provision to bank or provision to shares, whatever the answer is. If the target was not met, I'll say that means I will not pay you. That means, can I say there is no need of provision? So I'll transfer it to P&L. This was not required portion. I've written over here, not required. It is just for understanding that what after 2 years, I gave you an option for 2 years, right? Either meet the target or don't meet. If the target is met, I will give you shares. So the answer will be provision to shares. That is equity share capital. If the target is not met, entire profit, it is my profit. So provision to P&L will be the answer, right? Okay. Moving ahead. Next question. I guess this is the last question, and after that new concept are there: common control and demergers and reverse acquisition. So we are almost at the end, not very end actually. It will take some more time because since I told you it is a huge Ind AS and it will take a bit of time more, right? So I guess 2 hours more. Okay. On 1st April 21, Johnson Limited acquired a new subsidiary, Bosman Limited, purchasing all 150 million shares of Bosman. That means 1st April, I took the entire amount, 150 million shares, right? 150. So who is the acquirer? Bosman. Sorry, Johnson acquired. Sorry, the acquirer is Johnson and the DOA is 1st April. The terms of the sale agreement included the exchange of 4 shares in Johnson for every 3 shares acquired in Bosman. So I'll be giving you 4 for 3 into 4 by 3. On 1st April, the market value of the share of Johnson was 10 and the market value of Bosman was 12. Your value is 12, but my value is 10. I will give it 10 rupees. I will give it, obviously I'd give it 10. So Johnson is paying 4 shares for every 3 and he is paying the share of 10 rupees. Okay. So this is PC, right? This is PC. The terms of the share purchase included the issue of 1 additional share in Johnson for every 5 shares if, the answer is if. So can I say it is contingent? It is contingent, and contingent are measured at fair value on DOA. Fair value on DOA. If the profits of the Bosman Limited for the 2 years are more than the target figure, current estimates are 80% probable. See, they are giving percentage for just for confusion. I told you never to take the probability chances. Okay, so this is contingent consideration, again a part of PC. I'm just marking it. Legal and professional fees associated with the acquisition were 12 lakh, including 2 lakh relating to cost of issuing shares. See, this is the point, transaction cost, and transaction cost always go to P&L. As I told you, acquisition cost will not be added as a part of PC, it will be treated as P&L. Moving ahead. The senior management of Johnson Limited estimates that the cost of their time can be fairly allocated to the acquisition is 2 lakh. This figure of 2 lakh is not included in the legal and professional. See, if they are giving time to the merger or acquisition, this is of no use. Again, P&L. These are not basically, if they are doing some work, I am paying them. They do some work, I'll pay them. So basically, there are wages and salaries, not to be added as a part of PC. Moving ahead. The individual balance sheet of Bosman comprised net assets that had a fair value of 1200. Okay. Additionally, Johnson Limited considered Bosman possessed certain intangible assets that were not recognized in the balance sheet. That means 1200 million is your INA. Customer relationships estimate of value of 100 million. This value has been derived on the customer basis. So if it is not an asset for you, I can take it as an asset because for you it was self-generated. For me, it is purchased asset. So I will take this as INA part also. And in-process research and development should have been considered by Bosman, since the necessary conditions laid down in Indian accounting standards for capitalization were just satisfied by 31st March. However, the fair value of the whole project, including the research phase, is 50 million. See, in Ind AS 38, the rule says if it is research phase, it is P&L. Development, capitalize. But the rule in Ind AS 103 says, whatever your research and development are, if I am purchasing, it becomes my intangible asset. So this will also form part of INA. Anything which I am acquiring, may it be research or development or may it be customer relationship which you have not shown as an asset, I will record as intangible asset. Employee expertise for direct employees, that means again they become director and they will be paid. So these are basically salaries, will not be formed parting of INA. The market value of share of Johnson is rupees 11. So over here the fair value, face value is given and the market value is given as rupees 11 on 31st March 22. So at the end of the year, not right now, at the end of the year. So it is of no use right now. Compute the goodwill. Okay. Also state the treatment of contingent consideration. So I'll be taking the contingent consideration later. Okay. Just moving ahead with our answers. So can I say there are 2 pieces involved over here? First is the number of shares I'll be paying and the second is the consideration. Okay. So over here, acquirer is Johnson and date of acquisition is 121. I'm giving you shares, 150 million was your shares, 4 by 3, and I'm giving you on the date of acquisition and my value was 10 rupees on that date. Contingent consideration was again the fair value on the date of acquisition. The fair value is 10 rupees. I will give you 1 share for every 5 shares held. So 2300 comes as purchase consideration. Okay, what are part of INA? You can clearly see this 1200, this 100 and this 50. So these are all INA if you can closely watch. 1200, 100 and 50. Employee expertise is not to be taken, 1350. Next, NCI nil because 100% I took. This is the answer. Okay. And now they have asked for consideration. Also state the treatment of consideration as on 31st March. So please tell me, is it fixed number of shares or is it variable number of shares? The answer is fixed number of shares because I have clearly shown you 1 additional share for every 5 shares held. Is it fixed? Yes. So it will not be remeasured. So over here, you can say legal, I've just given the notes. Legal and professional won't be included. Payment to senior management won't be included. Employee expertise won't be included. And if fixed number of shares are given, it won't be remeasured. It won't be remeasured. Okay. What if it was variable? Then I would have measured at rupees 11. I would have measured it at rupees 11 because initially it was measured at 10 and now it is valued at 11. So obviously I would measure at 11 rupees. That is 1 rupee extra through P&L. Okay. So we are done with this point. And the last point before the next concept starts is measurement period and excess depreciation. You remember the measurement window of 1 year. Let's say I took over your business, and within 1 year I came to know about some INA changes which relates to DOA. At that time, depreciation will also be charged. So this is the only point which I have shown. See, look at the example. A Limited acquired 100%, that means complete balance sheet is mine for rupees 500 crores, and the INA was 400 crores. That means I have passed the entry of 100 crores as goodwill. Entire business is mine, 400, I am paying you 500, 100 I am paying extra goodwill. Okay. On 39, that is within 1 year, after 6 months, a fact came into notice that building which was taken at fair value 100 was actually valued at 150. That means you have to take as 150. That means 50 rupees extra. So will it be adjusted through goodwill? The answer is yes. Building to goodwill. Adjusted through goodwill due to measurement period. I've already explained. This was not important. Important was this point. Excess depreciation will also be calculated because on 39 you started. 39, right? So any excess amount, 50 crores, will also be treated, and this will also be passed. And after that, I have given one question just for your answer. Every point is covered in that. The only new point is this point in question number 61, which is just above, just after this. So in that point, there is also measurement window. I've already covered the measurement window in the previous questions. Extra point is whenever there is an asset and whenever depreciation rate is given, at that time till the measurement window, that is 6 months, you also have to calculate the excess depreciation for that. This is the important point in that question, right? Okay, moving ahead. So this is just a practice question. And now we are now starting with the next point, which is the common control transaction. Now what do you mean by common control transactions? Just look at the two diagrams. The first diagram states that A Limited is the parent and it has 3 subsidiaries X, Y, Z. Now what happened is one subsidiary acquired another subsidiary, X and Y. X acquired Y. So the diagram changes to like this. A is still the parent, and now there are 2 subsidiaries X and Z, and Y becomes a subsidiary. Y comes over here. That means X took over Y. Now can I say my subsidiaries are playing amongst themselves? If my subsidiaries are playing among themselves, I becoming the parent, that is A Limited, still is the ultimate parent. That means this is known as the common control transactions. The control is still with me. You are playing amongst yourself. The control is still with me. This is known as the common control. We have to change a few points in this, right? What are the few points? Accounting for common control transaction. It is similar to AS 14, which you learned in your intermediate. Even if you have not learned that, even if you have skipped that point, it is of no problem. It is known as the pooling of interest method in AS 14. But ठीक है, ignore करो इसको point को. Acquirer. Who is the acquirer? X Limited. I can say X Limited acquired Y, but who is the ultimate parent? A is the ultimate parent. So I'll write over there. First point, my 6 steps, right? First step is acquirer, X Limited, ultimate parent. Ultimate parent is still A Limited, right? Okay. DOA, whatever the DOA was there. Purchase consideration will always be in number of shares. It will not be in cash or something. And the important point in this states that we have to ignore premium. That means if X Limited is giving shares to Y Limited, let's say he gave 1 lakh shares of rupees 10 at rupees 12. I cannot take 12. I have to consider at 10 rupees. Common control transactions, right? So if the ultimate parent is still the same, and if there is a subsidiary acquiring another subsidiary, at that point of time, 90% of the questions will give PC in shares only. 90%, right? And in that scenario, you have to ignore premium. This is the first point. Second important point. INA, all the assets and liabilities this time will be taken at book value and not the fair value. This is the second point. First point, the shares will be taken at face value, not the premium. Second point, all the assets and liabilities will be taken at book value, not the fair value. Third point, the reserves and surplus will also be taken over this time. The first time it happened that this is the balance sheet. I will take over your assets. I will take over your liabilities. I will take over also your reserves and surplus, and I will just not take over your equity. That means I'll take over all your assets, I'll take over all your liabilities, I'll also take your reserves and surplus, and everything will be taken over at book value. If it is a common control transaction, right? Everything will be taken over at book value. NCA will not be applicable since I'm taking over 100%. And you will not write the word goodwill or GBP. Even if the answer is positive or negative, you have to write the word capital reserve. So basically, there are 4 points. How will you remember? See, first of all, ultimate parent remains the same. If the subsidiary is acquiring another subsidiary, it is of no use for you. The answer still is the same. What are the answers? 4 points are there. 4 points. What are the 4 points? First point is PC will be in shares and ignore premium. It will always counted at face value. Second point, all the assets and liabilities will be now taken over at book value. Second point. Third, first time I will take over your reserves and surplus also. And the fourth point is no goodwill, no GBP, or may it be positive, may it be negative, the answer will be capital reserve. You have to write the word capital reserve, not goodwill or GBP, right? Okay, so these are the points in common control. Over here, I have explained you one by giving an example. Question number 62. Please pay attention. Okay, these are the numberings from my book. So if you don't have any book, if you don't have my book, if you're not my student, if you're just referring the YouTube lectures, so I have already given the questions over here only. So you don't have to find anywhere. Okay. Smart Technologies is a company incorporated in India in 1998, having business in the field of development and installation of softwares, trading of computer peripherals and other IT related equipment, and provision of cloud computing services along with other services incidental thereto. It is one of the leading brands in India. It is of no use. I just want the company name. The company name is Smart Technologies. Okay, very smart it is. After that, after witnessing immense popularity and support in its market, Smart Technologies further grew by bringing its subsidiaries name as Cloudustries and Microfly. So basically, we have something like this. Smart has two subsidiaries, Cloudustries and Microfly. Both are subsidiaries. Okay, this is before picture. This is the before picture. Okay, moving ahead. Smart Technologies started preparing its financial statements based on Ind AS from 1st April on voluntary basis. The Microfly India is planning to merge the business of Cloudustries, which its own, for which it presented before the members in the meeting the below extracted of the latest audited balance sheet of Cloudustries based on the base of Ind AS for the following. Okay, that means what Microfly is telling. Microfly is telling that I will take over Cloudustries. That means Cloudustries will become a part of Microfly now. So the diagram will be like this. Smart Microfly will be the subsidiary and Cloudustries will be over here. Can I say ultimate parent is still the same, which is Smart, and therefore it is known as a common control. What were the 4 points? First, PC will be in shares. It will be considered at face value itself. Second, all the book value, all the assets and liabilities will be taken at book value. I will take over the reserves and surplus also, and any difference will be transferred to capital reserve. These are the 4 points which you need to consider, right? These are the 4 points. Now, the balance sheet of Cloudustries was given. The balance sheet of Cloudustries, that means the balance sheet which I am taking over, right? All the assets and liabilities are given. Okay, moving ahead. On September 5, the merger got approved by the directors. The purchase consideration payable by Microfly to Cloudustries is 18 crores payable in cash, and that Microfly will take over all the assets and liabilities of the Cloudustries. So this time they have given cash. Okay, so PC is given in cash, no problem. So what is the first point? Who is the acquirer? Acquirer Microfly. Ultimate parent still the Smart. Second, what is DOA? September 5, 17. Third, what is PC? 18 crores. Fourth, INA. Remember, when I will say INA, at that time I will take over all your assets, all your liabilities, all your reserves at book value. This was the third point, right? So the basic points are, I will take over all your assets, all your liabilities, including the reserves at book value, and the difference will be transferred to capital reserve. This is the only important point. So I have taken over here. You can see that. Acquirer, ultimate parent is still the same. Date of acquisition, cash was given. Okay. Take over at book value, including reserves and surplus. So I have taken all the assets 1, 2, 3, 4, all the liabilities, including your reserves. Reserves was in negative, and therefore I have taken it as a negative in liability. Reserves was already negative, right? Okay. So you can say 43 minus 2, it comes to 45. 43 minus 2. So basically, I just have to copy paste the balance sheet. It is that simple. I just have to copy paste the balance sheet. This balance sheet is mine. This balance sheet is mine at this figure itself. All your reserves are also mine. This is the point, right? Okay. And the difference will be transferred to capital reserve. Over here, institute has made a mistake. What is the mistake? They haven't taken the reserve surplus stating that they are negative. So basically this should not be done. I have given the proper answer, but institute has another approach to it. They haven't taken this. They haven't taken this, but it should be taken because it is written in the accounting standard. Barak, if you see, it is clearly written that all the reserves and surplus will be taken, may it be positive, may it be negative. So I have taken over here. Okay, moving ahead. NCI will be nil and capital reserve is 27. What is the normal journal entry? It is INA to bank to capital reserve. In detail, I'll write all the assets, all the liabilities. All the assets and all the liabilities, including your reserves, and that will be answer. That will be answer. So what I've done is I've taken all the assets, all the liabilities. So I've given the shortcut entry also, all the detail entry also. INA is 45. So how come INA was there? It was all the assets and the liabilities minus liabilities. So it comes to 45, right? So this is the answer. I hope the point is clear. And common control is this simple. It is very, very, very simple. Okay, moving ahead. Now the second part is demerger. See, apart from the regular questions, see, in the regular questions, what we have learned? We have learned PC, INA, very important, step 3 and step 4. Then I also explained you what is measurement window, right? Measurement window. PC, we have learned about deferred consideration, what to do of deferred, what to do of contingent consideration, SBP rewards, and so on. INA, I have already told you there are a lot of parts in INA, right? 9 parts were there. I have already explained you. Measurement window, 1 year window is there. And now we have also learned about common control. Common control. And now we are learning with demerger. Now what is demerger? I'll explain you demerger. See, let's say A Limited has 4 division. Division P, Division Q, Division R, Division S. And A Limited is holded by Mr. X. Mr. X is holding 80% stake and Mr. Y is holding 20% stake. Okay. So basically there are 4 divisions. Let's say I am dealing into laptops, I am dealing into TVs, and dealing into fridge, and I am dealing into mobiles. Mobiles, I have to demerge. That is, mobile, I have to remove from my business. I have to remove from my business, right? But I don't want to close it. So what I'm doing is I'm forming a new company named as B Limited. And I'm transferring only the mobile business to them. That is the division S. I'm only making one division to that. This is known as demerger. The recent case is of Vedanta. If you have heard the news, Vedanta has gone for demerger. You can check on the Google and you will get all the information. Okay. Demerger is nothing but setting one part of your company and giving it to another company which is newly formed, right? So obviously if the new company is taking over, over here you will be asked for both, for A Limited also and for B Limited also. Obviously B Limited is acquiring, right? This becomes the acquirer and A Limited becomes the acquiree. Obviously if B is taking the asset, if I am B, if I am taking your entire asset, if I am taking your entire division, I have to pay something. So the answer is, if it is issued in shares and there is a major stakeholder. So if B Limited is issuing 1 lakh shares, can I say 80% of this will be with X only? Can I say this becomes a common control again? Why? Because A Limited, who was the owner? X. B Limited issued shares. Okay, if this is the B Limited balance sheet, this is INA of division S, whatever the INA is. Let's say INA is 10 lakh only, right? Over here it will be equity, and in equity it is 10 lakhs, and Mr. X and Mr. Y are there. 80,000 shares will be given to X and Y, 20,000 will be given to Y. That means there was a major stakeholder, and because the PC was given in shares, still the owner of B Limited is Mr. X. So can I say Mr. X is owing this A Limited and is also the owner of B Limited? That means ownership never transferred. If ownership not transferred, it is known as common control itself. Now, what are the 2 answers? See, before demerger, A Limited had 4, control was Mr. X. After demerger, A Limited had 3 divisions and B Limited had division S, and division S, the control was only with X only. And therefore, it is known as the demerger with common control. Now, what are the 2 points? Both the conditions should be satisfied. Both. What are the 2 points? Demerged company, that is A Limited, should have a major stakeholder more than 50%. That means if A has a major stakeholder, that is 80%, he was having a major stakeholder, and the new company, which is B Limited, is giving the shares, is giving the answer in shares. If this is the case, this is known as demerger with common control. That means first, company should have a major stakeholder holding more than 50%, and second, the second company, that is a new company, should give PC in shares. If it is giving in cash, it will not be common control, right? Moving ahead, the second scenario, demerger without common control. Example 1. So basically, it is the entire same case. It is issuing 1 lakh shares. But the problem is over here, I was not having any major stakeholder. W was holding 25%, X was holding 28%, Y was holding 31%. Is there any major stakeholder? The answer is no. So even if it gives 1 lakh shares, no one will be the owner. And since no one will be the owner, therefore, it will be not under common control. It is without common control. Okay. Next. Example 2. There is a major stakeholder, but PC is paid in cash, and therefore Mr. X won't get any shares, and therefore Mr. X is no more the owner of B Limited, and therefore it will be without common control. So basically, if it is demerger, they are moving one division to another division. At that time, both the conditions should be satisfied for common control. What are the two conditions? The first company should have a major stakeholder, and along with that, the second company, that is the new company, is giving PC in shares. If it is giving PC in cash, it won't be counted as common control. Now, what are the difference? I have given again the summary over here. See, just 1 minute. Yeah, over here, I have given the summary. With common control and without common control. With common control, the major stakeholder and PC was in shares. Both the conditions will be satisfied. In rest cases, if any one of the conditions is not satisfied, it will be treated as without common control. Now, what is the basic difference? So basically, there is an accounting difference. So I'm treating with control and without common control. Point to be noted is, if it was common control, reserves were taken. If it is demerger, reserves won't be taken ever. Reserves won't be taken. I have clearly given you reserves won't be taken. Please make a note of this. Reserves won't be taken if it is demerger. It was only common control. Only common control. What was the common control? The subsidiaries were playing amongst themselves. It was common control. All the assets, all the liabilities will be taken over at book value. But if it is demerger under common control or without common control, reserves will never be taken over. So please make a note of this. Reserves will not be taken. Okay. With common control. What is acquiry doing? Can I say? Now think from the point of view of A Limited. What is A doing? Can I say A is selling off his business? That means what will A do? He will remove all the assets and remove all the liabilities of S. Now, to remove the assets have debit balance, to remove, make it credit. Liabilities have credit balance, to remove it debit. Any difference will be transferred to capital reserve. So this is the basic entry. If you can closely watch. Remove all the assets at book value, remove all the liabilities at book value, and difference in capital reserve. Don't record PC. Reserves will not be taken over. Please make a note of this. Reserves will not be taken over, and the entry will be liability to assets to capital reserve, or the difference will be transferred to capital reserve, right? This is the point. Please make a note. Reserves will not be taken over in any scenario. If it is a case of demerger, may it be common control, may it be without common control, reserves and surplus won't be taken over. Okay. Now, whether common control or not, acquiry will do the same. Same entry. Means, what is my job? If I am A Limited, I am handing over my business. I'll remove all the assets, I'll remove all the liabilities, difference to capital reserve. Only one single entry. Please make sure I will not give you my reserves. If, let's say, I am having laptops and having mobiles. Mobiles, I am giving it to you. So I will remove mobiles entirely. Whatever the assets are there, whatever liabilities or related to mobiles are there, difference will be transferred to capital reserve. I won't give you reserves and surplus of mobiles. I will still keep those reserves with me, is the first point. Okay. Acquiry will answer the same. Okay. The difference is with acquirer. With common control. What is common control? Common control, remember the steps. What are the steps? The PC will be in shares. All the assets and liabilities will be taken over at book value. I will record the reserves also, but I will not give the reserves. The difference will be transferred to capital reserve, not to goodwill or something. Goodwill or GPP, right? So you can clearly see. What is the acquirer doing in common control? You can see accounting for common control with demerger. INA to equity share capital, no premium will be recorded. If you clearly watch, no premium will be recorded. Difference to transfer reserve. INA to equity share, no premium will be recorded to capital reserve, or capital reserve will be debited. This is the acquirer. But if it is without common control, it is a normal question of 6 steps. If you remember, 6 steps, right? 6 steps. Acquirer, DOA, who is PC, INA, and so on. So everything will be taken over at fair value, and the rest is the same. So we have already done this. The important point is over here. So obviously, if the question is asked for demerger, they will be asking for this only, not for the acquirer, because common steps are already asked. So they will be always giving you with common control. What is the logic? All the assets, all the liabilities will be taken over at book value. Premium will not be recorded. the difference will be transferred to capital reserve. This time, in the previous common control and this common control, what are the difference? If it was only common control, if the subsidiaries were playing among themselves, at that time I will be taking over reserves and surplus also. But if it is demerger, I will not be taking over the reserves and surplus. Okay, moving ahead. So this is demerger with common control. It is a simple question of laptops and mobiles. Please pay attention. Enterprise Limited has two divisions, laptops and mobiles. Division laptops has been making constant profits while division mobile has been invariably suffering losses. So this is profit making, this is loss making. Obviously, I'll sell the loss making part. Mobiles, I'll be handing over to something. Okay, moving ahead. So I'm just not reading the answers over there right now, or not reading the balance sheet. Division Mobile, along with its assets and liabilities, was sold for 25 crores to turnaround. What was the name of my company? My name of the company is not given. Enterprise Limited. Okay, sorry. Enterprise Limited is given. It sold the mobile business to turn around. Mobile business to turn around. Okay, turn around. So this is the case of demerger. First point I remembered. Only one section has been sold, right? If one division is sold, this is the case of demerger. Okay, first point is there. Now it can be with common control, without common control. What were the points of common control? Easy. Major stakeholder and the PC will be in shares. Major stakeholder and the PC will be in shares. It will be considered as common control, right? Okay, let's continue. Who allotted 1 crore equity shares of 10 each at a premium of 15? See, they have given this for confusion. 15 will not be taken. Why not taken? Because in common control, premiums are not taken. It will be always at face value. This was the point which was very important, right? In full settlement of the consideration, in proportion to their shareholding, one of the members of enterprise was holding 52%. It is clearly given. Major stakeholding. So, is there a major stakeholder? Yes, major stakeholder hai. Plus, if the shares are given, can I say it is common control? Common control, right? Okay. So, they have given both the entries. Now, what is the basic entry? Think from the point of view of enterprise. Enterprise Limited. What is enterprise doing? Can I say he is removing the mobiles? Remove mobiles entirely from your books. How will you remove? Liabilities to asset to capital reserve. Simple as that. I'll remove at book value. What will I remove? Please check. I'll remove this liability. I'll remove this asset. I'll remove this asset. I'll remove this liability. Right? I'll remove everything. What are the difference is, will you transfer to capital reserve? Please make sure you are not giving this reserves to anyone. Reserves will be with me only. With me means with laptop only. Remove only the assets and liabilities and difference to capital reserve at book value itself. So first think from the point of view of Enterprise Limited. What is enterprise doing? Enterprise is removing everything. Just think like that only. So to remove everything, the entry will be liability to asset. Okay, over here I have given the journal entry. I have also given the diagram. There is also major stakeholder. Since enterprise has a major stakeholder and the PC is paid in shares, it is demerger with common control. Now, what is the answer I have given again and again? Enterprise, what will enterprise do? It will remove all assets, all liabilities, difference to capital reserve at book value. Don't record PC, don't transfer reserves and surplus. It is very easy. So these are the points of demerger, right? So how will I answer? I have removed everything and the difference is capital reserve. Easy. Okay. Next point. Then I have again, what is the second point asked? Prepare the balance sheet of enterprise. How will I prepare the balance sheet? I have removed everything. Removed everything means what? I have removed all the assets of the mobiles. I have removed all the liabilities. Please make sure, don't forget that I haven't transferred this reserves. This reserves is still with me. So I'll be taking this reserve only, right? So I have given the assets and liabilities, but not the reserves. So what I'll do is, I'll just copy paste my balance sheet and his reserves, plus the capital reserve arising out of the journal entry. So basically, what is my balance sheet? It is very simple. My balance sheet copy paste. Two things I have to take extra. First is your reserves, that is mobile reserves, and third, whatever the journal entry was, capital reserve I'll be taking in my balance sheet. That's it. So over here, if you can closely watch. PP over here. 250 minus 225, 25. Okay, next point. Current assets 200. Current assets 200. I have taken, right? Next. After that, equity 25. Only my equity will be taken. My equity is 25. Next. After that, other equity. This is important. Other equity. What was taken? My profit minus it was losses and 100 was capital reserve, if you remember. That's it. That is, I just copy pasted my balance sheet and two things. His reserves and the capital reserve arising out of it. And now it's term for turnaround. What will turnaround enter? turnaround. What will be the entries for turnaround? Remember the answers. Was this a common control? The answer is yes. So I will take INA to equity share capital, no premium, and the difference will be transferred to capital reserve. This is the point I have taken you. INA will be at book value itself. INA will be at book value, and either capital reserve in the debit or capital reserve in the credit. Premium will not be recorded. This was the point which I explained to you. If it is common control, all the assets, all the liabilities will be taken over at book value. Ideally, if it was only common control, reserve and surplus would have also be taken over. But this time it is demerger with common control, reserve and surplus will not be taken over, right? Okay. Then the difference will be transferred to capital reserve, not to goodwill, not to GBP. So over here you can see. Over here you can see what are the answers. So books of turnaround, INA at book value to equity share capital, difference to capital reserve. So I've already explained. I have taken all the assets and liabilities of mobiles. And I've given difference of to capital reserve. This is the balance sheet. I've given just in T format. You can make the actual format of balance sheet, right? And next, as per the institute has made a mistake. What mistake? They have given securities premium also, wherein they have clearly mentioned premium will not be recorded. But I don't know why they have recorded premium. It will not impact your balance sheet because premium and capital reserve, it will get set off. So you don't have to remember this. I feel this is completely incorrect. This should not have been done. But if they have given, you can continue with the same. If you remember this question, if it is copy pasted question, do whatever the institute says. But what I feel, this thing is correct. You cannot consider premium, right? This was common control. Okay. Over here, this is the maxi and mini. The last question for demerger, right? And after this, I guess only one concept is remaining, and that is reverse acquisition. Okay. So, and reverse acquisition plus small 2-3 points are there. Okay. Those are very easy. Major points is only one, that is reverse acquisition. Okay. Demerger with common control or without common control. What are the answers? Maxi and mini has two divisions. Maxi and mini. The draft information of assets and liabilities as on 31st October are as under. So they have given the two balance sheets over there. PPE, depreciation and all everything. Maxi and mini. Right. This is with or without common control. Now what is with and without common control? I'll just explain you with the question. It is decided to form a new company, Mini Limited, to take over the assets and liabilities of Mini division. So basically, we have a company Maxi Mini Limited, and Mini is transferred. That means, can I say Mini is just a division, and this division is getting transferred to Mini Limited now. Mini Limited. That means this is the case of demerger. This is the case of demerger. This is the case of demerger. Now, demerger is there obviously. Now it can be with or without common control. How will I recognize? There should be a major stakeholder and the amount should be paid in PC. PC should be made in shares, sorry. Now, accordingly, Mini Limited was incorporated to take over the balance sheet figures, the assets and liabilities of division. Mini Limited is to allot 5 crore equity shares of 10 each. The PC is paid in shares, right? Of the members of Maxi Limited in full settlement. The members of Maxi Mini are therefore to become members of Mini Limited as well without having to make any further investment. You are required to pass journal entries in relation to the books of Maxi Mini and Mini Limited. Also show the two balance sheets showing the corresponding figures. I'll read the second and the third point later. Now what they are telling? They are telling that Mini Limited has issued shares, but have they given any major stakeholder? The answer is no. So how will you consider it is major or not? In this question, since no fair value is given, right? It will hardly matter whatever you assume. So basically, I have given all the assumptions over here. There is no major stakeholder, and therefore this is demerger without common control. I feel this. But what is the institute assuming? Since everything is taken over at book value and PC is paid in the form of shares, everything is taken at book value, right? Because the rule is, if common control is there, everything will be taken over at book value. It is assumed that there is a major stakeholder and this is demerger with common control. As I told you, institute will never say demerger without common control. Why without common control? Because they always want common control. With common control, they have already taken, right? And therefore, they have given assumption this. There will be no change in accounting in either of the assumption, only in this question. Why not no changes? Because no fair value is given. So if I consider fair value also, book value becomes the fair value in this case, and therefore both the answer will be same. So इस क्वेश्चन में कुछ फर्क नहीं पड़ेगा, right? Okay, moving ahead. So what is the PC? 5 crore 10 rupees, right? If I am asking you from the Maxi Mini point, Maxi Mini, you are Maxi Mini Limited and you have to remove everything. What are the points you have to remember? I will remove all the assets. remove all the liabilities. I will not transfer reserve and surplus. This was the point. I will not transfer reserve and surplus. That means other equity, this other equity will still be with me. Okay, and the difference will be transferred to capital reserve. That's it. So the first point is, maximum. Remove assets and liabilities at book value. Difference to capital reserve. Don't record PC. Don't transfer reserve and surplus. The entry will be liability to assets to capital reserve. That's it. So liability to assets and differences capital reserve over here. So I've given the journal entry. I've just copy pasted over here. I've just transferred this mini entirely to another division. Remove the assets, remove the liabilities, difference to capital reserve. This is very simple. Okay. Next point. So I've given the answer before and after demerger. Now what is before and after demerger? See, before demerger, I've copied this balance sheet entirely. I've just copied in my format, in the proper format. Before demerger, the question itself. The question I have copied again. After demerger, what are the points? After demerger, can I say I don't have mini limited? I'll take only my assets, only my liabilities. The only point is I will not give my reserves. Reserves are entirely mine, plus capital reserve, whatever the answer was. So in journal entry, capital reserve was there. So over here, if you can see, 650 minus 300. Why minus 300? Because capital reserve was in debit. Debit means a negative figure, right? So minus 300, and this will tally. I have taken only my figures, and other equity was the only point which you have to remember. Okay. What will mini limited do? Mini limited, since it is a common control. If you remember, all the assets, all the liabilities will be taken over at book value. No premium will be recorded, and the difference will be transferred to capital reserve. So they have transferred to capital reserve entire thing, right? So what they have done, mini is taking over mini business, that is division business, and mini division, and therefore it will be recording like this. Now what is the third point they have asked? The directors of the two companies ask you to find out the net assets pre and post demerger. Comment on the impact of demerger on shareholders' wealth. So basically, net assets they have been asked. What are net assets? Net assets are nothing but assets minus liabilities, right? So if I calculate the assets before demerger, this is the balance sheet of Maximini before demerger. So what were the assets? 1000, and what are the outside liability? 300. So what was my net assets? 700. Okay. After demerger, my assets were 500, liabilities were 100. So what is the answer? 400. So I'll just take those only. Maximini. The answer was 700 crores and the answer was 400 crores divided by the number of shares which is given in the balance sheet. So my value was 140, but after demerger it became 80. Okay. And what was the answer for mini? Before there was no mini limited, right? Mini limited तो अभी form हुआ है, just they formed right now. So what is the answer for mini? I have given the balance sheet over here. 500 was the asset and the liability was 200. So can I say the value was 300? Net assets. Assets minus liabilities taken over net assets. So I have given 300 and the shares were 500 again. 5 crore itself. So the value was 60. Now you can closely watch. Initially there was only one company, that is Maximini. The value was 140. After demerger, the value of Maximini was 80 and the mini was 60. Can I say the shareholders are still getting 140 over here and 140 over here? There is no impact. That is, after demerger, there is no impact on the shareholders' wealth. So this was the proof of that. Demerger into two companies has no impact on shareholders' wealth, because before demerger, the net assets value of equity share was 140 and after demerger is again 140, which is 80 plus 60. That means after demerger, there is no impact on the shareholders' wealth. What are net assets? Assets minus liabilities taken over, right? This is the point. I hope the points are very clear till here. So this was demerger. And comes the last point, which is important point, which is reverse acquisition. Reverse acquisition. Now what is reverse acquisition? See, it is very simple case, not very tough. Reverse acquisition is A Limited acquired B Limited. Obviously, if I am acquiring, I have to give shares. And A Limited issued so much shares that the holding passed on to B. I'll repeat again. I'll give you an example, this example only. What is reverse acquisition? Reverse acquisition का मतलब होता है खरीदने गए थे और खुद बिक के आ गए. Basically ये होता है, right? So I'll just explain again. A Limited acquired 100% stake of B Limited. That means A Limited acquired 100% of B Limited. You can just watch the number of shares. Both are having 100 shares in their balance sheet, right? Both are having 100 shares. And issued 2 shares for every share of B Limited. That means B Limited got 2 shares. Obviously A will give to B. gave 200 shares, right? 200 shares. Now you can closely watch. If A Limited issued 200 shares, what is the balance sheet of A now? Can I say the balance sheet of A consists of 300 shares now? Of which 200 to B ke paas hai. 200 is having with B. Can I say, although acquiring is A Limited, A acquired B Limited, but the holding is still with B Limited. This is known as reverse acquisition. Now you will say, sir, why will A give 100 shares to them? 200 shares. It should give less than 100 shares. No, why is he giving more than 100 shares? Because the terms were like this only. Let's say B Limited was an unlisted company and A Limited was a listed small listed company, right? A Limited was a small company. B Limited wanted to become a listed company, but he was not able to become because there are a lot of paperwork and a lengthy process to become a listed company. So B Limited came with an idea. B Limited told A Limited that you purchase me. Obviously, if he purchases it, if A Limited purchases it, B Limited existence won't be there and it will be only A Limited, right? That is, A Limited will be the owner, right? A Limited. On paper, A Limited will be the owner. But B Limited also told them that give me majority of the shares to me only. That means I'll hold, I'll control. That means on paper A is purchasing, but actual control is with B because A Limited has given more than the number of shares what A was having. And this is known as reverse acquisition, right? So how to deal with such questions? There is only one important point, and that is known as deemed PC. What is deemed PC? I will explain you with the example first and then I'll explain you the formula. Okay, so look at this question. A Limited acquired 100% stake of B Limited and issued 2 shares for every 1 share. Means A Limited issued 200 shares to B Limited, right? Every 1 share I am giving you 2 shares. That is in the balance sheet of A Limited now. There will be 300 shares, of which A holds only 100 shares and B hold 200 shares, right? That means I have calculated in percentage. 33.33% is with A and 66.67% is with B. The major stake is with B over, and therefore this is known as the reverse acquisition. Means although A purchased B, but still the holding company becomes B, and this is known as the reverse acquisition. Now what to do? We have to calculate the deemed PC. Now what is deemed PC? Please pay attention. Although legal acquirer is A and acquirer is B, but from the point of view of accounting acquirer becomes B. That means I will account from the point of view of B. That means B Limited took over A Limited. I'll feel like that. I'll assume that B is taking over A is not taking over B. Although on paper A took, that is legal acquirer, on paper is A, but from the point of view of accounting, A is not acquiring the business. The holding company is B and B is acquiring, and therefore accounting acquirer becomes B Limited. This is known as reverse acquisition, right? Okay, the DOA will be given to you. The utmost important point is step number 3. Step number 3. What is deemed PC? Don't look at the formula. I'll give you with the example. Please pay attention. If B was the actual acquirer, think from the point of view from B. If B was the actual acquirer, how many shares was B having? How many shares were B having? B was having 100 shares, right? So just feel that this is 66.67%. So what will be 100%? Just cross multiply and calculate the number of shares. It comes to 150. That means it will be like this, that to maintain the stake of 66.67, assume that B Limited gave only 50 shares to A. This is deemed PC. B Limited gave, although B Limited is not giving any shares, but what you have to calculate is deemed PC. Assume that 50 shares have been given by B to A. Why 50? Because total shares will be 150, out of which 100 is B is keeping with themselves and 50 is giving to A because he wants 66.67% stake, right? So what we have to do is we just have to cross multiply. Assume that if B was the actual acquirer, if B was the acquirer, then how many shares would B issue to maintain his stake? B is having 100 shares in his balance sheet and he wants a 66.67% stake. So what will be for 100%? Just cross multiply, it becomes 150. Out of this 150, B will be left with 100 and B will issue 50 shares to A. This is PC. This is deemed PC, right? Now, how did I calculate this? So there is a formula. Even if you have not following the formula, even if you give the working note like this, it is completely okay with you. They will give you the marks. So Original shares of B, can I say it is 100%? 100 shares. Divided by stake of B, that is divided by 66.67%. Minus the 100 shares. It is something like this. See, over cross multiplication also you have done like this. What did you do? You said 100. How did you calculate this 150? It is 100 shares. 100 shares into 100% divided by 66.67. This is the cross multiplication, right? So this will come to 150 minus 100 shares. This will give it to A into, at what value? Obviously your value, fair value of B. So this is the formula given to you. Original shares upon stake of B minus original shares into fair value. So I don't feel on this form, don't keep on learning this formula. Just make a cross multiplication. It will be very easy for you. So what you have to do? First of all, think from the point of view of A. First of all, think from the point of view of A only. How will you analyze whether it is reverse acquisition or not? First of all, how many shares were you having? 100. After reissue, how many shares were you having? 300. Out of this 300, you are only the holder of 100. That means you give 200 to them. And therefore, 200 becomes 66.67. Now this 66.67 will come into picture. B Limited will say, I have 100 shares and this is 66.67%. What is the value of 100%? Just cross multiply and get the answer, right? So this is the answer. So over here, if you can clearly watch, although A Limited acquired B, but you will not form that is A is acquiring B. You will say B acquired A. So this time A will give over the business. All the assets will be taken over at fair value. All the liabilities will be taken over at fair value, right? And if it is this common control, equity will also be taken. That is other equity, but this won't come. The important point is, don't forget the deemed PC over here. Deemed PC, that is equity will also include deemed PC. That is, you will not say only 100 shares, but you will say 100 plus 50 shares. And also calculate the goodwill. That is 6 steps. Follow the 6 steps and you will get the answer, right? Okay. NCI will not be applicable as per exam point of view. So point number 5 is not there. And 6 will be PC minus INA directly, right? Okay. Let's follow one question of reverse acquisition, one of the important questions. On 31st December 21, entity A issues 2.5 shares for each share. Just get in touch with the admin department and they will provide you with all the details. Okay. Yeah. Okay. So on 31st December 21, entity A issues 2.5 shares in exchange of each share of entity B. All of entity B's shares holders, just 1 minute. Also, you can drop in your contact number in the comment section and my team will get in touch with you if possible for you. Okay, let's continue. 42, reverse acquisition. On 31st December 21, entity A issues 2.5 shares in exchange of every ordinary share of entity B. That means entity A is giving 2.5 shares for each share. एक share के बदले 2.5. For one share, I am giving you 2.5 shares. All of entity B's shareholdings exchange their shares in entity B. Therefore, entity A issues 150 shares in exchange of all 60 shares of B. That means B Limited had equity of 60 shares only. For this 60 shares, 150 shares have been issued. That is 2.5 times, right? 60 into 2.5. Okay. The fair value of each ordinary share of entity B is 40 rupees. So the fair value is 40 rupees per share. 40 rupees per share. Moving ahead. The quoted market price of entity A's ordinary shares at that date is 16. So the quoted market price of entity A is 16. That means if I am talking about A, the fair value is 16 rupees per share. Moving ahead, the fair value of entity A's identifiable net assets and liabilities are the same as their carrying amount, except that the fair value of entity A's non-current assets is 1500. That means non-current assets are 1500. NCA is 1500. Okay, only one change, fair value. Rest everything is at book value. The balance sheet of entity A and B are as follows. Okay. I'll just have a look at the issued capital over here. 100 equity shares and 60 equity shares. Just pay attention over here. So over A had equity of 100 shares. This is before acquisition, okay, before. And B had equity of 60 shares. After acquisition, after, the picture was something like this. A had 250 shares. How come 250? Because it has also issued 150 shares. So out of this 250, 100 is with A only, but 150 is with B. Can I say the answer in percentage is 40% and 60%? That means B is the holding company. Although A acquired B, A issued the shares, but B is the holding company in this scenario. And therefore, how will I calculate? See, this 60 shares are 60%. So for 100%, how much? Like this. It will be 100 shares. Out of this 100, 60 are with me only. 60 is with B. That means 40 shares is with A. This is deemed PC. 40 shares will be with A. So this is how you should analyze the question. First, write only the shares A of B. After A should be 250. So write the percentage and then use this percentage. Use this percentage over here. If this percentage is this, 100% is how much? Out of this 100%, 60 is with you, 40 will be deemed PC. Obviously, you will give this at your fair value. At your fair value. What is your fair value? Your fair value is 40 rupees. 40 rupees. So 40 into 40 will give you 1600 as the deemed PC. This is how you will calculate deemed PC. Rest everything is very simple. See. Assume that B's earnings for the annual period ended 31st March were 600. 31st March was 600 and that the consolidated earning for the annual period on 31st March 22 was 800. See, this is of no use as of now. Why? See, this is DOA 31st December and what is asked? Calculate the fair value of the consideration and measure the balance sheet on 31st December 21 itself. Can I say this is, they have asked balance sheet on DOA, and when they ask on DOA, it becomes Ind AS 103. They are giving information of 31st March 21 and 31st March 22 is of no use because this will be done in Ind AS 110, that is consolidation financial statements. That is the next subsequent years, right? Assume also that there was no change in the number of ordinary shares with B with the annual period and during the period from 1st Jan to 31st March. Calculate the fair value. Okay. Now, since they have asked this, that is, we are following Ind AS 103 and not 110. What we have to do? We just have to follow what I have told you. Equity shares of B after acquiring 100 plus 150 shares, that is 250. 60% will be with B. So I've already calculated. First is the acquirer. Although acquirer was A and B, but accounting acquirer is B and then acquiree becomes A. DOA is 31st December. Deemed PC, as I told you, 60 shares were there, divided by 60%, minus the original shares into my fair values, 400, 600, right? So out of this 40 rupees, 10 rupees is the capital and 30 rupees is the premium. Institute has not given this bifurcation, but you have to give this bifurcation for sure. Equity is 10, 30 rupees is the premium. INA, how to calculate the INA? All assets and all liabilities at fair value. Only one fair value was given. Only one fair value was given. If I'm taking over, please make sure you will take off A limited because you are taking over A, not B. Not B. Remember this thing because this is reverse acquisition. Although A acquired the business of B, but A actually sold the business to B only, right? This was reverse acquisition. So fair INA of A will be taken. How to take INA of A? Take all the assets and all the liabilities. Not the equity, obviously, not the equity and other equity, not this. And after taking this at a fair value, only one fair value was given, which was this 1500, right? NCA fair value, that is this one. This 39 becomes 1500, that's it. So this will be taken as INA and next is goodwill 300. And now what you have to do? You just have to calculate the answers. Please don't forget what you don't have to forget is nothing but deemed PC. You just have to calculate the deemed PC, that's it, and the goodwill. That's it, and you will be able to solve the entire question. Okay, moving ahead. Now this is again a reverse question, practice question, so I'm not taking it. It was just a practice question, right? And ideally, okay, I've taken everything, so why not this question? Let me take this question also. I'll be taking everything, okay, not leaving any of the point. So after this, refer question number 38. I have given this. What is the concept question? A and B. A is having this balance sheet, B is having this balance sheet, right? Equity, reserve, surplus, current liability, NCL, non-current liability, current asset, and non-current asset. Fair value of business is given. This is the new point which is given to you. Fair value of business and fair value of business. 1500 and 2500. A and B merged and new company AB was formed. So this time the problem is A was formed and B was formed. A and B were formed, right? And AB took over. AB company is new company, and this has taken over A and B. Now the problem is the holding is with AB, not with A and not with B. This was done in AS 14 in your intermediate. But in the finals, they say, I don't believe in AB. Company तो A और B है ना यार, जो पुरानी company है, the old companies are A and B. Obviously, one will be the holding company in between them. One will be the holding company. So I have to either hold A or B as the holding company. This is the point, right? Okay, moving ahead. Fair value of business is 1500 and fair value of business 2500. So I can say 37.5% and 62.5%. Right? Obviously, the value is more of B. And since the fair value is more of B, the business is a broader business of B, I will consider B as the holding company. And therefore, this is known as, again, the concepts of reverse acquisition itself. Why reverse acquisition? Simple sa case. Actually, there was a new company formed AB to acquire the business of A and B, right? But we will not say AB is a new company. No. Holding company will be one of A or B. On what basis? On the basis of the fair value of business. The fair value of business was more of B, and therefore 1500 and 4500 becomes 4000, right? Total. So 1500 is 37.5% and 2500 is 62.5%. Since the fair value of business was more of B, holding company becomes B. That is, B is the acquirer. We'll feel like that. B acquired the business of A. That means B is taking over A. A will be transferred to B. This is the point. So this is again the point of reverse acquisition. How to calculate deemed PC? Again, using the same principles. How many shares were B having? Don't say 800. The number of shares are 80, right? So you will take 80 shares as 62.5%. How much is 100 shares? It becomes 128. So out of this 128, 80 becomes B and the balance amount comes to 48, which is A. What is the fair value? It is not given. This was the important point. How to calculate the fair value? See, the fair value will be counted as the fair value of business divided by the number of shares. You are having 80 shares, right? And this 80 shares, the fair value is 2500. So what is the one value of one share? It becomes 31.25. So into 31.25, this will be termed as deemed PC. 10 rupees will be capital and 21.25 will become premium. This one was very important, this one. In this question, the fair value was not given. Only this is the new point in this entire question. Only this is the new point, right? So what we have to do? We have to consider the fair value of business. If the number of shares are not given, if a new company is formed, we will not say it is a new company. We will say any one of you is the holding company. How will I consider holding, which is holding and which is subsidiary? I will calculate the fair value of business which will be given to you. Just based on that, give a holding right to one of the company. So the holding right comes to with B. B acquired A, we will feel like that. That is, even if A and B are getting merged, I will not say it like this. I will say B has acquired A because the fair value of business of B was more. And since it is a case of reverse acquisition, how will I consider? Again the same rules. I am holding 62.5%. That means my 80 shares are 62.5. What will be your shares? So this is the reverse case. But the important was how to calculate the fair value. The fair value of business was given divided by number of shares. This will give you the answer as 31.25. This is the point. I hope the point is very clear, right? Okay, moving ahead. Now, this is a question. Last question, probably the huge question. AX and BX amalgamated on 1st Jan. The word is amalgamated. And they formed an ABX company with shares of rupees 10 to take over the business. I will say no, AX and BX are not the companies. ABX is not the new company. Either AX or the BX has to be the holding company. I have to give the accounting acquirer to one of the company, right? So I'm not reading the balance sheet. I'm just getting over here. ABX Limited issued a requisite number of shares to discharge the claims of the equity shareholders of the transferred companies. Also, new debentures were issued in exchange of the old debentures of both the companies. It's of no use. Just write the debentures word. Prepare a note showing purchase consideration and discharge thereof and draft the balance sheet of ABX Limited. Assuming that both the companies are under common control, assuming BX is a larger entity and their management will take over the ABX. Now they have clearly given BX is a larger company. See, common control is copy paste the balance sheet, don't take over the reserves and surplus, right? Okay. So I'm just making the first point. Assuming both the entities are under common control. So common control is very simple. I'll take over all the book value of the assets. Assets is 13050. Liabilities is 4000. Assets are 15200. Liability is 5500. So over here, assets minus liabilities, you will get net assets. Net assets minus the reserves and surplus, will give you the final answer. How come I calculate this? If you remember, I already told you I will take over all the assets, all the liabilities, including the reserves, right? So the answer comes to 6000 and 7000. This is clearly given to you. That means I will give you 6000 and 7000 as your net assets value. Now moving ahead, discharge of PC. AVX will issue 13,000 in net assets. How come 13,000? This is 13,000. This is 13,000 in the ratio of net assets. This is the important point. In the ratio of net assets. So AX and BX, 6275 and 625. You are done with the first point. Assuming both the are under common control. Under common control, if you remember, all assets, all liabilities, including the reserves, whatever the value comes to, you have to give this value. That means you have to give 6,000 to this and 7,000 to this. How will you give? Obviously, total of 13,000. But you will not give 6,000 and 7,000. You have to give in the ratio of net assets. You have to give this 13,000 in this ratio. So AX will get 6275 and BX will get 6725. This is the point. Only you have to consider this. Okay, moving ahead to the second point. Assuming BX is a larger entity. BX is a larger entity. Since BX is a larger entity, I will say accounting acquirer is BX. Accounting acquirer is BX. How will I calculate? See, very simple. The values of fair value was given. Fair value. Fair value is 11,000 and fair value is 14,000. Just now I explained this, right? 11,000 and 14,000. So this is what percentage? This is what percentage? They have given 44 and 56%. So I will consider accounting acquirer. 56% is 700 shares. How come 700? Obviously BX is the acquiring company. BX. So over here, this is having 700 shares and 56%. So how much is 100%? And transfer. And calculation of fair value is nothing but divided by number of shares. So this is the fair value. Obviously, I'll be giving my shares at rupees 20. So this is rupees 20. Since it is rupees 20, 10 will be capital and 10 will be premium. And this is how I calculate the deemed PC. For INA, obviously, I'll be taking the fair values which are clearly given to you. The fair values are given to you right over here. PP and inventory have changed. Rest everything is same. Rest everything copy from the balance sheet. So over here, only two are fair values and rest all are book values. I'll calculate the INA, NCI not applicable, and then you will get the answer as goodwill. So this is the answer you will be calculating. So I hope you got this point. It is very simple, not very tough, right? Okay. And now we are left out with small points, right? It will hardly take like 15 to 20 minutes and we are done with this Ind AS completely. So I've taken everything. Before moving ahead, what we have covered? We have covered PC. This one, yes. We have covered PC. PC important points are shares, bank, deferred consideration, previous investment, that is associate, contingent consideration, and SBP. The next was what to include in INA. I've already told you what to include in INA. Important points were contingent liability, indemnifying asset, and deferred tax. Next is common control. Sorry, I'll be using measurement concept, measurement window. Next is common control. What was the important point in common control? 4 points were there. 4 points. The PC will be included in shares, ignore premium. All the assets and liabilities will be taken over at book value. No reserve and surplus will be taken over, and the difference will be transferred to capital reserve. This was the common control. Next, we learned demerger. Demerger with and without common control. With and without. Without is very easy, 6 steps. But with, the important point was same points as common control, only except 1 point. Except 1 point. What was the except? That is, reserve and surplus will not be taken over. This was the important point, right? Okay. Next, we learned about reverse acquisition. Reverse acquisition, important point was deemed PC. I hope you are able to calculate the deemed PC. If not, then you obviously will be getting these notes. Just practice deemed PC 2 to 3 questions. Calculate only deemed PC. That's it. Rest everything is simple. Obviously, I'm just trying to cover each and every point. I won't assure you that marathon देख के चले जाओ direct exam में. Just look at the marathon and just look at the revision lecture and go and sit in the examination. Don't do this, because there is no alternative to writing practice. You have to write a few questions. Only then you will get a confidence, because you will not be able to tally the balance sheet if you do not write. You should have the writing practice. Only then you will be able to tally. Okay. Okay, moving ahead. Concentration test. Now, this is one of the theory points. What is basically concentration test? See, I need to check whether am I acquiring the asset or whether I'm acquiring the business. Let's say, if I'm acquiring the business, obviously I'll take over all your assets, all your liabilities. But what if I'm paying you 1,000 crores, and 950 crores I'm paying only for the building only. Only 50 crores is the rest of the things. At this point, I cannot say this. I have acquired the business. I'll say I've only acquired the building. That is asset acquisition, not the business acquisition. This is very important. So basically, this is only optional test. This is not compulsory. This is not compulsory. Only if they ask what give something about concentration test, at that time you have to give this point. Okay. This test is done to check whether the transaction is an asset acquisition or business combination. What is concentration test? If it is met, if the concentration test is met, it is an asset acquisition. If the concentration test is not met, then it is business combination. And if it is a business combination, further assessment is required. Okay. So what is the point? The main logic of concentration test is to check whether whole PC is paid for one single class of asset or full business. Now, whole PC means at least 90% is paid for this class. Again, this is only 90% which I am telling you. Ind AS hasn't specified it. It is majority portion. Now, what is majority portion? They haven't specified it. Okay. Now, what are the steps? First, calculate the adjusted PC. Now, what is adjusted PC? Whatever the PC is there, include NCI also in that. Remove the cash and DTA since these are non-core assets, and add all the liabilities except DTL. So you'll have to learn these points if you have to follow concentration. What I'm doing is I'm calculating the adjusted PC. What is adjusted PC? Total PC, whatever that is. NCI add kar do, add the NCI. Subtract cash and DTA because those are non-core assets, and add all the liabilities except DTL. That is, deferred tax will not be added over any point of time. Second, fair value of single major class of asset. So whatever assets you are taking, check what is the major class. Let's say building is the major class. So what is the fair value of that only class? That building. Okay. And step 2 divided by step 1 will give you the answer. Step 2 divided by step 1. If you have to check the percentage, that is whatever the amount you are paying, is this you are paying for that. Step 2 divided by step 1. If 90% or more, then test is met, and therefore we can say it is not a business combination, it is asset acquisition. So if it is more than 90%, again, it is not necessary only judgment. Ind AS does not say this if it should be 90%, right? Okay. Now to explain this, I have given a question. Please pay attention. Entity A holds 20% interest in entity B. Subsequently, entity A further acquires 50% in entity A by paying rupees 300 crores. That means initially I was having only 20%, and now I have acquired 50%, and I have acquired by paying 300 crores. What have I acquired? I have acquired 1,000 crores of building, cash of 200 crores, and liabilities of 800 crores. That means 1200 minus 800, 400 crore liya hai. DTL is 150 crores. Fair value of entity B is 400, and the fair value of NCI is 120. Fair value of entity's previously held investment was 80. Okay. Entity A needs to determine whether acquisition is an asset acquisition or not. Okay. So now what is the point? PC, I paid 300 crores. It is clearly given. I have given 300 crores. What is the previously held investment? It was 120. It is clearly given. Yeah, 120. Just 1 minute. Okay, mistakenly I just amount over each ho gaya thoda sa point, theek hai. I just stumbled it. So it is 80 over here and 120 over here. Yeah. So previously held investment is 80. It is clearly given to you. NCI, I told you to add 120. It is 120 given to you. Minus the cash and DTA part. Is the cash and DTA part is given? Yes. Cash and DTA is 200. Just subtract. Add the liabilities and not the DTL. DTL is ignored. Add the liabilities 800. So I have taken 800. So it comes to 1100. So first, it is known as adjusted PC. How to calculate the adjusted PC? It is PC plus NCI minus cash and DTA, add liabilities, except DTL, right? So this will be the answer. And what is the single major class of asset? The building was given. Single major class is 1000 building. And step 3 is step 2 divided by step 1. It comes to 90.90% test met. And therefore we can say it is an asset acquisition and not a business combination. That means I gave you this amount just to acquire your building only. I can say this. Again, this is just optional. This is not compulsory, right? This is not mandatory. Okay. So this was 64th question. Okay. Remember the replacement reward? I told you SBP will be of two types. First is replaced and second is non-replaced. Now what do you mean by non-replaced? Non-replaced का मतलब ये होता है, if you are the B limited and I am A limited, I am acquiring your company. You have already issued options to your employees, right? In that scenario, I am telling you, you only handle this liability. I will not give my shares to them. You only give their shares. In that scenario, the accounting remains the same. Pre and post, it still remains the same. The only point is instead of adding it to PC, I will add it to NCI. It has no impact on the big questions, and therefore I have not included this part. The only change, if parent does not take over the SBP plan, the SBPR of the subsidiary is classified as NCI and CFS. See, it is a very simple logic. If I am not taking your liability, obviously you have to issue shares. That means if you are issuing shares, your shares will be distributed more. That means my control will decrease, right? In short, NCI will increase, and therefore it will go to NCI. Now there are two options. If the shares are vested, now what do you mean vested? The plan was of 5 years till date of acquisition, and completed 5 years have lapsed. पूरे 5 साल हो गए. That means your company has given 5 years plan and already 5 years are passed. That means there is no obligation on me, and only share issue is pending. At that time, completely classify as NCI. But this is not the scenario. The important point is over there. Pre-combination and post-combination. The accounting still remains the same. Like 500 into 2, if you remember, divided by 5. The accounting still remains the same, pre and post. The important point is it will not go to PC. It will be termed as part of NCI. So you can solve. Computation same as part of replacement. The only difference is they will form part of NCI. Over here also, remember post acquisition will be transferred to P&L. The answer is no, it will not be transferred to P&L. It will be transferred to again NCI. This is the only point. Accounting still remains the same. So I have taken a question over there. It is the same question as of the previous question. If you remember, 500 into 2 divided by 5. So entirely the accounting remains the same. The only difference is this will be NCI. Now how to calculate NCI? See, if you remember the 6 steps, 5th step was NCI, 5th step. So whatever the NCI is, just add up 200 to it. That's it. This is the only point. So don't include this in step number 3, which is PC, include in step number 5, which is NCI. This is the only change. That's it. Nothing else, right? So calculation still remains the same. Okay. Next, determining what is part of business combination transaction. Now, exactly, I must say, whatever I'm paying is PC. But this is not the only scenario. There are two things which is considered as they are not the complete PC. They are part of business combination. Now, what is that? See, if I'm paying you 500, and 50 was the previous settlement. 50 was of previous settlement. Something was pending. At that time, 450 will be treated as PC, not 500. That is, if there is certain amount of previous settlement, then at that point of time, you have to consider 450 as the PC. I have given an example. Just look at the example. I have given not one but two examples. On 1419, B Limited filed a suit on A Limited. B Limited has filed a suit on A Limited. A Limited 1419, okay, 1419. Just ignore this information, okay, ignore this information. After that, on 1423, A Limited acquired B Limited by paying 400. That means after 4 years, the company who filed a suit against me, I purchased that company itself. मैंने वो company ही खरीद लिया. I purchased that company. B Limited actually filed a suit on me, and I purchased that company itself by paying them 400 crores. So you will not consider that 400 is the PC. No, because obviously now what will happen, since B Limited is my company now, I will withdraw my case. Obviously I will withdraw my case. So can I say, just to avoid that case on me, I paid him 400. That means there is certain amount which is that of that case also, right? So now obviously B Limited will withdraw that case. Case fair value on date of acquisition was 20 crores. That means if on this date on 1423, if I did not purchase B, I had to pay 20 for this case for sure. I will still consider the same. I will say out of this 400, I have paid 24 Ks only and 380 I have paid to acquire B. I will consider it like this, right? That means if at all there is previous old settlement, one of which is pending, I will consider 20 as the previous settlement and 380 as the payment, right? So it will be assumed that out of 400 paid to 400 paid, 20 crore is paid to settle the old transaction and 380 will be considered as the PC as per Ind AS 103. This is nothing but determining what is part of business combination, right? Okay, moving ahead. Next, remember reacquired rights. I told you one point is still pending, one point, and this is the point. See, A Limited, remember I gave the franchisee first at rupees 1500 for 10 years. 1500 was the answer. After 4 years, your value came to 900. Your value came to 900. And then I acquired at 6,000. The fair value is 1,000. At what value should I take 1,000? True, 1,000 I will take. But the important point is, यहाँ तक हो गया था आपका. This you have already studied. This will form part of INA. You will take 1,000 as INA. True. But now the point is, means we are paying 100 crore extra to acquire. That means those are my rights only. I only gave you the right. I only gave you the franchisee, and now I am only taking your franchisee again. That is reacquired rights at 1,000. That means 100 I am paying extra. True. Okay. Now forget that. We have taken over B Limited. Just forget that I have taken over B Limited. Okay. And wants to cancel the franchisee. I'm telling that forget this thing. I'm telling right at this point of time, cancel this franchisee. I don't want to give any franchisee to you. You cannot. Mic check. Okay. Yeah. Okay. Continuing further. So A and B, I was telling. So I was telling that I will not pay you extra, na? If there is penalty of 150 or 100 rupees extra, what will I pay? Obviously 100 extra. Why will I pay 150? So in that scenario, 100 rupees will be treated as the previous settlement and 5,900 will be considered as PC. That is 100 will be previous settlement. I will treat it like this. So the PC amount will be 5,900 and not 6,000. I will consider it like this, right? So this is nothing but reacquired right. Since it has no impact on big questions, I have kept it at the end, right? So reacquired rights have no impact. It is very easy. What you have to do is just take this 1,000 as a part of NC, as a part of INA. That's it. Nothing else. Okay, moving ahead. So this is the reacquired rights. I have given the question over here. Okay, we'll continue with this question. ABC Limited acquires PQR for a consideration of 1 crore. Okay, that means I am ABC, you are PQR. I am acquiring your business for paying 1 crore. 4 years ago, ABC has granted a 10-year license to PQR to operate in Europe. The cost of the license was 250. Okay, the contract also allows either party to terminate the franchisee at a cost of unexpired initial fee plus 20%. Whatever the unexpired fee is plus 20%. At the date of acquisition, the settlement amount is 180. That is, how did it calculate 180? See, out of this 250, obviously you must have depreciated for 4 years. So 25,000 per annum after 6 years, that is after 4 years, 1 lakh will be separated and 1,50,000 will be the WDV today's date. If I have to cancel whatever the unexpired WDV is, I have to pay 20% extra. That is 1,80,000. So can I say 30,000 I'm paying extra? 30,000 if I have to cancel it. ABC Limited has acquired PQR because it sees high potential in the European market and wishes to exploit it. ABC Limited calculates that under the economic conditions and at current value, it could grant a 6-year franchisee at 4,50,000. That means as of now, I can grant a franchisee of 4,50,000. How is the license for a part of business combination? See over here. As per Ind AS 103, reacquired rights are taken over at fair value under INA. This point I have already explained. I'll be taking over at fair value. But the company also need to evaluate whether any payment is made to settle the old transaction. Is there any payment for old transaction? In the present scenario, the settlement amount of the old transaction is as follows. 450 is the fair value of the license today. Carrying amount today is 150. That is, extra amount paid is 3 lakh unexpired period. Or the cancellation penalty is 180, whichever is lower. So what will you pay? You will pay 180, right? You will pay 180. So out of this 1 crore which I have paid as PC, I'll say 180 is for the previous old settlement and 9820 will be considered as PC. Now you will say, sir, how come you took 4,50,000? See, in today's value, if I issue a license for 6 years from now, I have to give 450. And the current value of the license is 150. That means extra amount is 3 lakh. I have to pay 3 lakh rupees. Or the cancellation penalty is nothing but 180. So what is the amount? What is the amount? The current fair value is 450 and the penalty is 180. What will you pay? Obviously, you will pay 180 because you will cancel it and then take back the franchisee, right? So you'll have to pay 180 as the pre-existing relationship, old settlement. Okay. Now, this I've already taken. I'll just explain you one basic idea. So this was the first question which I took. Okay, calculate the GBP and the goodwill from both the methods, if you remember. Now, if you get a GBP, there can be asked a theory question. What is the theory question? The theory question is, if you get a GBP, this is very rare. Goodwill is always the scenario. But if you are getting GBP, then it is very rare. And then you have to search for reasons. What was the reason behind this GBP? What was the reason? If the reasons are clear, then it will be transferred to OCIR, that is reclassified. First, it will go to PNL, that is reclassified, and then to capital reserve. And if the reasons are not clear, directly transfer to capital reserve. Ultimately, it will go to capital reserve only, but the rules are a bit different. That means if you are getting the GBP, at that point of time, you have to give a note. If you are getting a GBP, the conditions are very rare to get a GBP. If we'll search for reasons, if the reasons are clear, why is there a GBP? At that time, it will be considered as OCIR. From reclassified, it will go to other equity only, capital reserve only. But if the reasons are not clear, it will directly go to capital reserve. Actually, the net impact is capital reserve only. But the standard says that you have to search for reasons if there is GBP, because goodwill is very common, but GBP is very rare. GBP, that is, if you are acquiring a business of 1,000, paying 1,200 is very common. But if you are acquiring a business of 1,000 by paying only 900, this is very uncommon. This is very rare. I will not get a business at a lower price. If this is rare, you have to search for reasons. If the reasons are clear, OCIR. If the reasons are not clear, directly to retain earnings. This is again the important point. No impact on big questions. That is, consider GBP as capital reserve. No worries, right? Okay. And this is the question again. Basic question of goodwill and GBP. I've already taken it, so I'm not repeating this question. Okay. Yeah. And the last question of this Ind AS. I'll again come directly to the point. So this has all the intangible assets. Whether intangible assets can be taken over, the answer is yes. Intangible assets can be taken over. So I'm reading this question. Please pay attention. The last question. So it will hardly take 5 minutes. Okay. As part of its business expansion strategy, KK Limited is in process of setting up pharma intermediates business, which is at a very initial stage. For this purpose, KK Limited has acquired on 1st April 100% stake of ABR that manufactures pharma intermediates. That is, I have taken 100%. The purchase consideration for the same was by way of share exchange valued at 35 crores. They have given the PC. 35 crores. I have given you shares. Okay. The fair value of ABR's net assets was 15. That means PC is 15 and net assets INA is 15. Sorry, 35 and 15. A patent owned by ABR. KK, we are the acquirer. Right. I have acquired ABR. A patent owned by ABR for an established successful intermediate drug that has a remaining life of 8 years, A consultant has estimated the value of the patent to be 10 crores. However, the outcome of the clinical trials for the same are awaited. If the trials are successful, the value of the drug would fetch the estimate as 15 crores. Obviously, they estimate the value of 10 crores and now they are telling if the trials will exceed, I will take as 15 crores. Now, can I calculate this as intangible asset as part of INA? The answer is yes. Next, INA has developed and patented a drug. ABR has developed and patented a new drug which has been approved for clinical use. The cost of developing the drug is 12 crores. Based on early assessment, the valuer has estimated its market value to be 20 crores. Okay. So again, this is part of INA. There's a note behind that. I will tell you the note in the solution. Next, ABR's manufacturing facilities have received a favorable inspection by a government department. As a result of this, the company has granted an exclusive 5-year license to manufacture and distribute a new vaccine. Although the license has no direct cost to the company, its directors believe that opening the license is a valuable asset which assures guaranteed sales and the value of the same is estimated to be 10 crores. You cannot record that, but if I am purchasing, I can record that. Again, intangible asset. That means all the intangible assets can be recorded. Now at what values? Obviously, 15 crores was the INA, it was clearly given over here, right? Second, patent is of 10 crores. Why 10 crores and why not 15 crores? Because the trials are successful. If the trials are successful, if it will successful, then only I will be that benefit. Obviously, I'll record 10 crores. Next asset is of new drug. 12 crores or 20 crores, the fair value, 20 crores. So I've taken at 20 crores, but there's a note. What is the note? It is the note as per Ind AS 38, intangible assets. And the value of license is 10 crores. I've taken the value of license as 10 crores. Now, the same question, Institute has presented two answers. Same question. Same question. What is the answer? The only answer is depending on note 2. Assuming that the patent for new drug has an active market and therefore the market value is considered. Now, if suppose, let's say the active market was not present as per Ind AS 38, at that time I would have taken only 12 crores and not 20 crores. This is the only change because the institute has given a note. So whenever you are giving intangible asset market value, you have to give an assumption note that assume that there is an active market. Now, it is GPP, obviously PC, and all of these are INA. All of these are INA, that is Identifiable Net Assets. Now, I'm done with everything. I've covered each and every aspect of this Ind AS and I hope everyone got this point. If you still have any queries, feel free to ask. If you still have any queries, and I'm again telling you, there is no alternative for writing practice. You have to write a few questions. You have to tally the balance sheet by your own. Only at that point of time, this revision will be successful for you. I'm teaching over here. I'll be revising each and every point is of no use unless and until you have a writing practice. You have to write, then only it will fetch you some fruits. Yes, please tell me. If you have any query, feel free to ask. If you have any query, feel free to ask. Well, I guess no, you don't have any query. Okay, then let's stop for here. And as I told you, the next session will be for Ind AS 110, that is CFS, and the schedule have already been posted. You can check out the YouTube channel or the Insta handle, everywhere the information is spread, right? So I'm just ending up the stream now.